We are going to go through probably many trust moments. This is probably another mini earthquake version of this with the downgrade.
You don't have to be bearish, but boy, it's hard to be bullish.
I don't think that we're looking at a stampede out of treasuries.
We are taking profits rather than rethinking the basic strategy.
I think the worst is behind us, but I don't think the coast is clear just yet.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday as President Trump heads to Capitol Hill, preparing to tell Republicans to overcome division and get behind his tax bill. Just as Fed officials signal they might be on hold until at least September, investors looking for another read on the U.S. consumer. Earnings from Home Depot dropping right now.
Yeah, we are getting right now first quarter comp sales coming down lower by 0.3% versus the expectation of 0.2%. They do maintain their fiscal guidance. As we parse through all of the details, we are seeing margin expectations come in lower. The key question will be, how will they offset some of the tariff pressures? Will they sort of repeat what we heard from Walmart in terms of increasing prices, just maybe not referencing the reason why, which is potentially tariffs?
Stock is down 1%. Lisa nails it, as always. It's the commentary about pricing, retaining your customers, maximizing your profits, and don't blame it on the White House. Otherwise, the president might have something to say.
Well, exactly. You want to be very careful about how you talk about policy coming out of Washington when you have a president that has no problem taking to Truth Social or a press secretary going to the podium and blasting a company. We saw that with Amazon. We've seen that over last week when the president was traveling with Apple. So you have to really read between the lines when these companies come out and talk about how tariffs might impact their bottom line, and also if it means they're going to pass on that cost to consumers.
We know consumer sentiment is rock bottom. We've seen that in survey after survey. We've seen it in surveys in the past week. It's about whether you start to see it in the hard data and the earnings.
Because right now, when we talk to people who oversee credit card portfolios, they're not necessarily seeing it, whether it's MasterCard or whether it's Bank of America. What's interesting is how some of these companies are managing it. With Home Depot, what you are seeing is inventories for the first quarter up dramatically. That's not a shocker. How much are companies doing this? And they are eating it, to use the phrase du jour, a bit on their margins, with margins coming in and expected to come in for the full year. Key question will be, especially for the housing industry, it's still sluggish. So are people going back to renovating rather than just simply buying a new home, given the fact that you've got high prices, you've got high rates, and things aren't bad enough to be good when it comes to the rate picture for a lot of the housing market?
Do you remember the Moody's downgrade? That was fun.
No. What are you talking about?
What Moody's downgrade?
24 hours Moody's downgrade.
Are you Moody?
What an unwind in this market in one afternoon. The bond market this morning, by the way, totally unchanged, 445 on 10s. But some of the moves worldwide, eye-catching. Through 5% on a 30-year in America, the highest yield we've seen going back to 2023. In Japan, the highest yields we've seen on a 30-year when that maturity debuted going back to 1999. It's not just the US, it's Japan too. There's fiscal challenges worldwide.
So you have to watch bond auctions everywhere, not just in the United States, because you had a bond auction that was one of the worst auctions in decades in Japan. And by the way, this fiscal issue is not just a United States issue. This isn't just a Sell America issue. In Japan, you not only have deficits that are significant with some of the leadership, including the prime minister, saying that it rivals Greece, that it's worse than Greece. You're also seeing the fact that the Bank of Japan is pulling back in the face of some of the inflationary pressures. This is a global story. It's not just Sell America.
We're focused on the U.S. side of things, that's for sure, as the president heads down to Capitol Hill to try and rally Republicans to get behind his tax bill.
The closer going to the Capitol. Speaker Johnson wants this bill on the House floor. So through the Rules Committee, 1 a.m. Wednesday, and then on the House floor before Memorial Day. So who better to come and really start pushing these Republicans to get in line? This is a very tight rope that Speaker Johnson has to walk. Last night, there was no deal on SALT as he met with New York Republicans and a California Republican. That is what lingers. But any concession he gives to one group, he then has a whole host of headaches with another group. And that's the problem right now.
We'll head down to Washington in just a moment. Tyler Kendall standing by. Coming up this hour, we'll also catch up with Ed Yardeni of Yardeni Research, warning of a potential bond market meltdown. Nowrasteh of the Cato Institute as Trump heads to Capitol Hill, and Priya of JPMorgan on fiscal fiscal sustainability risks. We begin this hour with stocks and bonds steady as traders look past the latest US credit downgrade. Ed Yardeni of Yardeni Research writing, bond prices might melt down if the bond vigilantes are roused by the downgrading of the US sovereign debt rating and or the prospect that Trump's tax cut bill worsens the federal budget deficit. Ed joins us now for more. Ed, welcome to the programme, sir. It's good to see you. Good to catch up. Let's get to this call. This bond market. What is more likely in your mind? A bond market meltdown or a stock market melt up?
Well, my mind changes on that issue day by day, depending on how the markets are actually performing. Look, the 10-year is actually hanging in there at 4.5%. But as you said, there's some very unsettling developments going on in Japan right now, as an example. And there's more and more talk about a Liz Truss moment in Japan and even in the United States. That's what happened back in 2022 when the UK Chancellor decided to have a very loose budget and the bond vigilantes reacted badly. It almost feels like, bond vigilantes of the world unite. As you said, it's a global bond market now, and this fiscal problem that we're facing in the United States is also one that they're facing in Japan. And the way things are going, looks like Europe is going to be entering that stage as well. So I would say on a near-term basis, it's more like watch and see. I don't want to kind of ring the alarm bells and tell you that we're going to have an imminent meltdown. People like Ray Dalio have been saying that for a while, and it hasn't happened. And you have to remember, the Treasury here in the United States has demonstrated November 1st of 2023 that they can play games here. They can simply issue more bills and fewer bonds and notes. And that's what happened on November 1st of 2023. And the bond yield hit 5% and didn't see it again for quite some time. Hasn't seen it since.
And how much comfort can you take from the buying that took place yesterday? That when we do see yields back up, particularly through 5% on a 30-year, we struggle to close at those levels. That level gets bought. How much comfort can you take from that?
I take a lot of comfort from that. First of all, there's this notion going around that there's going to be a buyer's strike and suddenly we're going to have these auctions where nobody shows up. That's just nonsense. We're always going to be able to sell these treasuries. Just the question is at what yield? And will that yield be prohibitive enough to cause a recession? I think right now we're kind of in the, let's be on the alert, let's kind of the yellow zone. We're not in the red zone on this issue.
How much are you looking at the potential for stocks to be more of a haven than bonds and stocks to continue to perform, particularly when it comes to some of the big tech names, even if yields stay where they are right now?
That's a great question. And I think the answer is in the performance of the market since April 8th. That was the bottom of the correction. For February 19th to April 8th, we had something like an 18% correction in the S&P 500. And it's been a V-shaped recovery ever since. And leading the way have been the Magnificent Seven. And one of the reasons they're magnificent is they don't have that much debt and they have a lot of cash. And they're generating lots of earnings. So I think there's something to be said for the Magnificent Seven being a valued asset class again. And that, by the way, also helps the dollar because foreigners have been big buyers and then sellers and now maybe buyers again of the Magnificent Seven.
It feels as though the word risk is being turned on its head, where stocks might be less risky than bonds when it comes to bond vigilantes uniting around the world. Yeah. And potentially you could see a scenario where even emerging markets end up outperforming developed markets because they've already had this reckoning. They've already had sort of the fiscal restraint thrust upon them by years of volatility and higher costs. Is that something that you see transpiring, that suddenly the risk was going to lie in developed market sovereign debt and potentially even just beyond bond markets and not so much even in emerging markets?
Well, I think we clearly have entered a very volatile period right now, and it's pretty hard to get all the twists and turns of these markets, and which are driven by the twists and turns of politics in Washington and other places. I think that there is a potential here for the bond market to for the bond vigilantes to saddle up and to basically say that the deficit solution that the administration comes up with here in the United States is not sufficient. and that there could be a protest with the bond yield jumping up to, 4.75%. Maybe that'll do it. Maybe it'll take 5% again. But we have to get the attention of the politicians. The bond vigilantes have to get the attention of the politicians. And this may be sort of that moment. And it could all kind of unfold in a 2 to 4 week period where the politicians suddenly see the light that the bond vigilantes really are checkmating what they can do.
Well, you talk about the prospect that the tax bill can worsen the federal budget deficit. When you look at the Committee for a Responsible Federal Budget, they say this is going to add $3.3 trillion to the debt over the next 10 years. What do you think the bond vigilantes have to say about 3.3 over 10 years?
Well, they're definitely getting twitchy. But look, again, I think it's very important to realize that the bond vigilantes are not the only players here. The Treasury can play games with, I call it yield curve control, is sponsored by the Treasury instead of the Fed. The Fed, if this becomes a financial panic, could come in and buy bonds. So I think it's important to realize that there could be a lot of volatility. It could get panicky again, but I think you have to look through it all. I think any panic that occurs, to the extent that it does lead to a political response that calms the situation down, would be a buying opportunity, and that's kind of the way I look at it now. I'm not in the Ray Dalio camp that believes that we're heading towards a debt crisis and it's something that's just structurally going to kind of bring the system down. I think that we could have a debt crisis scare, and that could actually create some pretty positive reactions out of Washington. Maybe it's wishful thinking, but it beats the alternative.
Ed, can we put some numbers on those words? Panic, scare. What does that look like in fixed income?
Well, I think if we saw 5% again, that would get everybody's attention, especially if it goes to 5% and then 5.25%, and it doesn't come right back down as it did in 2023. I think 2023 was really an example of what could happen. That was sort of a mini debt crisis, but that was resolved with Janet Yellen telling the bond vigilantes, you don't want me to issue any more bonds or notes? Fine, I won't. I'll issue bills instead, and that worked really quite well. But inflation was also turning out to be more moderate than expected. Up ahead here, if we sort of see this supply-demand issue come to the fore and the bond vigilantes really get upset about the lack of fiscal discipline coming out of Washington this go-round, then it's really quite conceivable that with inflation likely to be a problem up ahead here, that things could get a little testy here going into the summer.
Ed, appreciate your take. As always, sir, it's good to catch up. Ed Yardeni there of Yardeni Research, the man who coined the phrase bond vigilantes. The 10-year this morning, 4.45. Max Kettner over at HSBC talking about the danger zone for equities, calling that 470.
Yeah, and that was really something that we heard from Ed Yardeni too, saying maybe 4.75 was the danger zone. What strikes me is how can anyone buy a 30-year treasury when no one can understand the framework? And we just heard that from Ed Yardeni, who specializes in frameworks and says that he changes his opinion from day to day with the different twists and turns that we see in Washington, D.C.
Yeah, bond market meltdown versus stock market meltdown are two very different stories, aren't they?
Yeah, coin flip.
Priya Misra, JPMorgan Asset Management, joining us a little bit later to talk about fixed income. Look out for that. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. Home Depot shares are rising 2% in the pre-market. The home improvement retailer reported first quarter earnings that missed analyst estimates, but reaffirmed its guidance for the full year. The company's CFO noted a drag on sales in the winter months due to weather conditions, weakening consumer sentiment, and economic turbulence, but saw improved demand in March and April. Meanwhile, President Trump is heading to Capitol Hill later this morning to try and seal a deal on his big, beautiful bill. Trump has told GOP holdouts to, quote, stop talking and get it done. But there is still disagreement over the bill's tax breaks, cuts to Medicaid, and green energy programs. Even if the bill passes the House, it will face an uphill battle in the Senate. And Qatar's prime minister rejected criticism of his country's offer of a $400 million luxury jet to President Trump. He defended the gift as an exchange between the two countries. White House Press Secretary Caroline Leavitt said the plane will be retrofitted to the highest of standards by both the Department of Defense and the U.S. Air Force. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, the president goes to Capitol Hill.
Looking to get the one great, big, beautiful bill. It will be the greatest tax cuts in history. If we don't get it, that means the Democrats will have stopped us.
We'll get into those very fine margins down on Capitol Hill in just a moment with Alex Nowrasteh of the Cato Institute. Live from New York City this morning. Good morning. The S&P posted a six-day winning streak on the S&P 500 just yesterday. This morning, pulling back by 1/4%, wiping out a 1% loss in yesterday's session. Big turnaround in fixed income too. The 30-year yield yesterday, a 13 basis point trading range, finishing the session lower by something like 4 basis points. This morning, up by 2. We're back to 492 with the tax bill very much in focus. Under surveillance this morning, the president goes to Capitol Hill.
Looking to get the one great, big, beautiful bill. It will be the greatest tax cuts in history. If we don't get it, that means the Democrats will have stopped us, and that means people will get a 68% tax increase, the largest in history. And if we do get it, we're going to have the largest tax decrease in history.
It's the latest this morning. President Trump heading to Capitol Hill to push House Republicans to unite behind his tax bill as lawmakers remain divided on key issues. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome to the program. What are those key issues for the president today?
Yeah, hey, John, good morning. Well, while Republicans have pretty broad agreement when it comes to the tax cuts at the heart of the package, there are still some really big questions here about the future potential impacts to benefit programs like Medicaid and also what's going to happen to lifting the SALT cap. In fact, we know that the members of the so-called SALT conference have been lobbying for President Trump to get involved in these negotiations directly. Congressman Mike Lawler said as much on this program last week. And this group of lawmakers from high-tax states even met last night with House Speaker Mike Johnson, but they emerged without any progress on a deal, though they did say they were offered multiple proposals. At the heart of this is that fiscal hawks say if there's going to be a more meaningful lifting of the cap, there has to be more savings policies, whether that is spending cuts or revenue raisers. And the sense here in Washington is that Republicans are really coalescing around the idea of moving up those work requirements for Medicaid from 2029 to 2027. But still, these members of the House Freedom Caucus are pushing for some more aggressive and in some cases controversial changes, including potentially changing how the federal government allocates money to states to put into place Medicaid benefits. So still some really big open questions here. The sense is that President Trump is going to urge these Republicans to move this legislation along because at this point it's just going to come back around when the Senate makes its own changes. And John, at this point, though, really doesn't seem like any of these lawmakers are going to back off of these policy fights as they really dig in their heels on their respective issues.
So the president wants to close a deal today, at least to get this measure to the House floor, first through the Rules Committee, of course, 1 o'clock in the morning on Wednesday. Then you mentioned the Senate. What are the discussions right now in the Senate for the pushback they're going to have with the bill the House is going to send over?
Right. There's a few really key issues that we're going to be watching closely, and they have really made clear that they're going to make some significant changes. One, of course, has to do with any potential impacts when it comes to Medicaid. This is something that Senate Republicans have already signaled that they're going to be reluctant to make changes to the program, including when it comes to the acronym known as FMAP, that formula that really determines how much federal money ends up going to the states to allocate it out in this program. The second is I would also watch closely the future of those clean energy tax credits under the Inflation Reduction Act. We've already heard from some senators a reluctance there to speed up phasing out or even phasing them out completely, as they really want to look towards the private sector that has been able to capitalize on these clean energy tax credits. And then just quickly, lastly, I mentioned we haven't even gotten into the fact that we are expecting an increase to the debt ceiling to be linked to this proposal. And there's already some pretty big differences in the numbers that both these chambers want to see there, with the House urging for a higher lifting of that cap.
All the things we enjoy in Washington. Tyler, looking forward to your reporting down in Washington, D.C. Joining us now is Alex Nowrasteh of the Cato Institute. Alex, welcome to the program. Your line on the tax bill. The tax bill is advancing through Congress. It needs a makeover. What kind of makeover does it need?
Yeah, I need a substantial makeover. I mean, listen, they've added in 20 extra tax preferences. They've undermined simplicity in the bill. They have added in stuff like the no tax on tips. They're not phasing out the IRA quick enough. What they really need to do is return to a lot of the key principles that made the 2017 TCJA such a success. Go back to full expensing, make sure that starts immediately, and phase out the IRA. Clean energy spending immediately. If they don't do that, there's going to be a bonanza of tax credits going out the door in the first year or two before it fully expires. And they really need to start bending the cost curve on things like Medicaid. I mean, we keep talking and hearing about these cuts, but so far what we really see is just reductions in the rate of increase. We need to start getting serious about this, or otherwise the tax reform is going to be much less impactful than it was before.
Alex, let's first start with the IRA. A lot of congressmen and women and even senators are saying they need those tax credits because businesses already started to make plans based off those grants from the prior administration. Are you saying they should cut them immediately, or do you think it's appropriate to have a phased out approach?
Well, I think we need to cut them immediately. I mean, they're very economically irresponsible. It will hurt a few businesses, of course, who have made decisions and business decisions based on the IRA, but those are just a great example of why we can't have these types of bad laws going forward, is that they are economically inefficient. They are very expensive to the taxpayer. Businesses and consumers make plans on them, but they are fiscally unsustainable. My colleague Travis Fisher did a fiscal analysis of the IRA out through 2050 beyond the budget window and estimates between about $2.5 and $5 trillion of outlays, which is somewhere around 10 times what the CBO originally estimated the cost of the bill to be. So this is just, it's too expensive. We can't afford it. We're running deficits way above what we should be running with this amount of economic growth. And it's fiscally unsustainable. It's totally worth cutting. And we should have done it. We should have never passed it in the first place, frankly.
You also think that Medicaid, they should at least loosen up or restrict some of the access to individuals that get on Medicaid. Isn't that really, though, kind of a third rail for Trump? He said he really doesn't want to touch any of these entitlements.
No, that's absolutely right. Politically, it's very difficult. I mean, President Trump, as well as senators like Josh Hawley of Missouri, who's a Republican, basically will go to the bat to defend a lot of Medicaid spending. And this is really too bad. Medicaid is growing rapidly as a share of federal spending. It is fiscally unsustainable. And the formulas that give grants to the states are very gameable by firms and by state governments on the state level, where they basically engage in these tax and subsidy gimmicks to get more and more money out of federal taxpayers. And the evidence isn't very good that there's big health benefits from this, from these programs to begin with. So I think that they're great ways to begin cutting back. But when they talk about, for instance, work requirements, I support them. I'm in favor of those. But they're really not going to do a huge amount to lower those costs. They're really like the opening salvo. But to bring down the cost, you really have to go after FMAP. You really have to go after the amount of money going from the federal government and from federal taxpayers to state governments. And there is just not that much enthusiasm for doing that, unfortunately, in the Trump administration.
Alex, appreciate your time as always. We'll catch up again soon. Alex Nowrasteh of the Cato Institute on the tax bill coming together down in Washington, D.C. We'll catch up with the chair of the Council of Economic Advisors in the White House a little bit later on this morning at 8:15 Eastern Time. I just want to understand, does anyone walk into the negotiations with a 30-year yield and say, look, we've got a problem, we need to do something about this?
You literally read my mind. My one question is, how often do you check yields, and which yields are you watching most closely, and how much is that a subject of conversations? Because ultimately, as we heard from Ed Yardeni, that could be the ultimate check. I also am wondering, does Donald Trump have the same kind of ability to get everybody together when there isn't a sense of exactly how? And it's a little bit harder to say, just do it. Get the votes done. And they're like, well,
Steve definitely checks the bond screen, because yesterday he had a call with reporters and there was a question about what was going on in the bond market. And he said, well, actually, I just checked now when we're back to unchanged. So Moody's is a lagging indicator, basically repeating what the Treasury Secretary had to say.
And the Treasury Secretary was right based on the price action yesterday in the bond market. The 30-year yield, 492. Yields higher by just 2 basis points this morning. Up next on the programme, another read on the US consumer. Drew Redding of Bloomberg Intelligence as Home Depot reaffirms guidance, adding the company won't pass along tariff costs from New York City. That's up next. You're watching Bloomberg TV. 6 days of gains on the S&P 500, a morning of losses so far. Mild ones, we're down by 0.25% on the S&P. On the Nasdaq 100, we're down by 0.4. Over those 6 days, again, more than 5% on the S&P 500 and up almost 20% from the low on April 8th. A phenomenal rally in this equity market, wiping out a 1% loss at one point in yesterday's session. Big turnaround in fixed income as well. On a 30-year yield yesterday, a 13 basis point intraday range. Just ridiculous. 492 this morning, yields higher by a basis point or two. But as Lisa and I were talking about at the top of the hour, this is not just the United States. It's Japan. It's other nations too. And Japan in focus again. Look at this move. Japanese bond yields on a 30-year maturity, the highest we've seen in some 26 years. 310 on a 30-year yield, up by 13 basis points this morning, and some yen strength kicking in. Dollar yen down to 144.56.
And this came after the weakest auction of bonds in Japan, going back more than a decade. And the real concern here is really reminiscent of what we're talking about here in the United States. You have the Bank of Japan pulling back and not supporting the long-term bond market at the same time that you have pretty significant deficits. You have questions around inflation. And suddenly you have this real question about the sustainability of a developed market economy that was once considered one of the stalwarts and the havens in the global market.
Top tip for any official out there: if you are potentially facing some fiscal problems, don't refer to Greece and say it might be worse than them.
I mean, honestly, what was he thinking? The prime minister came out, and that was on Monday, yesterday, and said this. And some people were saying that things were getting a little, to use the president's words, yippy yesterday in the Japanese bond market. That continues today. And you really wonder how much this is a global bond vigilantes unite type of story that could permeate through the rest of this year.
Particularly given some of the supply we might see out of places like Germany, which is where we've not seen a lot of supply, relatively speaking, over the last few decades. The equity market's doing okay. We're down by about 1/3%, but a big turnaround in yesterday's session, and the winning streak continues. 3 hours away from the cash open. Let's get you some morning movers with Yahira. Hey, Yahira.
Hi, John. We start with Home Depot. Those shares are rising 2%, even though sales fell short of expectations, telling us that unease over the economy did keep people from taking on those home improvement projects. But this could be why shares are rising. Home Depot CFO striking a more positive tone when it comes to navigating tariffs, saying that it's working to diversify its sourcing and that because of that, they won't need to raise prices. Next up, we have shares of UBS. Those are falling 2.5%. The bank had been lobbying the Swiss government to water down a law that would have required it to maintain up to $25 billion in extra capital, but to no avail. We're reporting that it is likely not to win that effort, though it is important to note that the text of the law is not final, so its prospects could still change. And last up, we have shares of United Health. The stock, of course, had been beaten down this year, and especially after the Wall Street Journal reported that it was under criminal investigation. But today, it's up 3%, adding to 8% of gains yesterday on a vote of confidence from new executives. Both their new CEO, Stephen Hemsley, and the CFO bought $30 million worth of shares. John?
Yahira, thank you. Thanks for the update. More from Yahira in about 10 minutes' time on the news flow out there. News flow just tremendous at the moment. On our radar this morning, our top story, President Trump heading to Capitol Hill to unite the GOP behind his big, beautiful tax bill. House Speaker Mike Johnson attempting to push the package through the House before Memorial Day.
It's a very aggressive timeline. It's going to be incredibly challenging, which is why he had to call the president, the closer, come to the Capitol. Can we get at least this hurdle done in the House? Tyler brings up a great point. Even if they're able to pass this bill in the House, whole set of new issues that are going to happen in the Senate. The issue right now for Mike Johnson, who I'm going to be sitting down with just a few hours after the Rules Committee votes for it. So whether or not he's giddy and excited or he's going to feel a little bit depressed, gets to go back to the drawing board to try to get it out of committee, we'll be able to decide based off his tone and tenor Wednesday morning. He has this very challenging tightrope. Any concession he gives to any group means he has another headache on the other side, whether it's the Medicare group, the SALT group, the fiscal hawks. The margins are just too slim.
This is going to be a much more difficult exercise to try to get everybody together than in previous efforts. And really what's at stake, and Punchbowl put it really well this morning, that it seems like the House Republican Conference has vastly different interpretations of Trump Republicanism and what that means when it comes to either fiscal responsibility, when it comes to pro-business tax cuts, or when it comes to cutting back certain entitlements, even if on the margins. And that's ultimately the reason why there cannot be a consensus, and it's unclear where the president is going to weigh in or whether he even will, given the fact that he's talked about how he has a soft spot for salt and for the northeastern states at the same time that he really does want to make sure that we see some of these other programs put through.
There's a lot of circles to square.
Yes.
I think we're all aware of that. It's difficult to please both the salt caucus and at the same time the fiscal hawks. And you were right to ask, what is a fiscal hawk these days down in Washington, D.C.? My cheat guide for Washington for any political operation is ambition. What is the ambition of the people involved? They want to get re-elected. If you want to get re-elected, most people believe it's political suicide to cut costs too much, to cut spending too much. There's one man who's not going to be re-elected because he's not running again, and that's the president. And there are some senators out there that will be up for re-election, some representatives of Congress that will be up for re-election, and that will be on their mind in a massive way as they approach these negotiations.
Absolutely. We're just around the corner from midterms, so they want to get a bill across the finish line that they can go back to their districts and say, I was able to, Mike Lawler from Westchester, raise your salt cap. What's so interesting about Trump is that we have seen a flip-flop on salt. He is the one that instituted a $10,000 cap in the first iteration of his administration with TCJA. Now he's come back, Nassau County, on the election cycle, talking about the fact that we need to lift this salt tax. So I think it really depends, to Punchbowl's point, what faction he's leaning in towards any given day with what priorities he wants to see in this bill.
The good news, Lisa, 30-year, 492. The right side of 5% going into these talks later.
Yeah, it depends, though, who you are, because on one hand, you get the feeling that there are some investors out there who are rooting for the bond vigilantes to call into check ahead of some of these negotiations. So maybe this isn't enough to call in that kind of fiscal responsibility, but at the same time, looks pretty good.
Priya Misra joining us in about 15 minutes. Look out for that conversation. Speaker Johnson with Annmarie tomorrow morning, 9:30 Eastern Time, right here on Bloomberg TV. Let's turn to this story. President Trump saying Ukraine and Russia will start ceasefire negotiations immediately after a phone call with the Russian President Vladimir Putin. Sources telling us here at Bloomberg the European leaders feel Trump is disengaging with wider diplomatic efforts.
So this is the quote that stood out to me from the president yesterday. Quote, I think something's going to happen. If it doesn't, I'm just going to back away and they're going to have to keep on going. It feels like he is leaving it in the hands right now of these two leaders, Vladimir Putin, Volodymyr Zelensky, to come sort of agreement that they can at least get to a ceasefire, some sort of process. And basically what Trump is saying, if they can't get there, I'm not going to continue on this battlefield. I'm not going to continue to try to get these two individuals to the negotiating table. I think what's interesting right now, the next question for Washington is really whether or not, if the talks go so sour, if Trump is willing to add more sanctions on Russia.
There's a similarity here with the tax bill, because increasingly there's a real question of how much power Trump has with the rank and file in the Republican Party. We heard Lindsey Graham, senator, come out and say that he's really rallying hard behind a bill to sanction, with potentially even secondary sanctions with Russia. And then John Thune, also a senator, majority leader, also came out and said if the White House concludes that tougher sanctions are in order, we're here for it, and that bill is ready to go. So you have the two sides, a softer take from President Trump and some Republican senators saying, we're not totally comfortable with that and we're preparing for alternative scenarios.
We spoke to Signum yesterday. If there were two conversations, one between the president and the Europeans and another one between the president and the Russians, which conversation would be the hardest? And he said it was the conversation with the Europeans and not the Russians.
Right. It's a conversation with the Europeans to basically say we need to have some concessions to make sure we get these two individuals at the negotiating table. I think one of those big ones is going to be how quickly you can get European arms to Ukraine. And if there's a ceasefire, do you absolutely just halt them? It's going to be very challenging for Europe. Remember, this is a war on the European soil.
That's the latest on foreign policy. Let's turn to the latest on earnings. Big week for retailers. Home Depot this morning reporting first quarter earnings that fell short of analyst estimates due to weakening consumer sentiment. The company's CFO saying it won't raise prices due to tariffs and reaffirmed its full year forecast. The stock is up on the latter, not the former. We're higher this morning, Bramo, by 2.5%.
Yeah, not only reaffirming, but also this idea that they can potentially absorb prices better than other places. They said that after they rearrange their supply chains, no country outside the U.S. will represent more than 10% of its purchases. So showing how much they can really be resilient, even in the face, potentially, of the proposed levies.
Drew Redding joins us now of Bloomberg Intelligence. Drew, welcome to the programme, sir. Just to build up on Lisa's line of thinking, just how insulated is this company from the tariff story?
Well, look, Home Depot purchases about 60% of their products that they sell from North America, about 50% from the United States. Them, just like a lot of other retailers, have done a lot of work over the last decade in diversifying their supply chain away from China. And, you know, you heard Lisa mention that by the end of the year, no country is going to be more than 10% of sales. So they have done a good job to navigate this tariff impact. I don't think they'll be completely immune. I think the comment they made was that they're looking to generally maintain prices. The interesting thing for Home Depot is they sell about 30,000 to 40,000 products in their stores, so they could take a portfolio approach to pricing. So they might not necessarily be raising prices on goods that were tariffed, but they'll look at the elasticities of their various products and raise prices where they can.
I do wonder if Home Depot is kind of a counter-cyclical tell, given the fact that a lot of people who own homes tend to go to Home Depot to get corking or little door fixtures or other types of home improvement projects. Drew, did you get a sense, reading through the transcript ahead of that 9 a.m. call that they're going to have with investors, about what type of consumer demand there is? Is this the good kind, meaning robust, resilient economy, or is this the bad kind? No one's buying homes and everyone's trying to make do with what they've got.
Yeah, that's a great question. And you're right, home improvement generally does tend to be more counter-cyclical. And the reason for that is because there's a large maintenance and repair component to the business. And I think that's really what supported Home Depot in the near term. And you've heard that from them in this latest earnings release, is that they're seeing homeowners take on smaller projects. What we're not seeing and what we want to listen for on the call later today is how are big ticket projects trending, and particularly discretionary products. So think of things like kitchen, bath remodels, flooring projects, which consumers are able to put off. That's really been the area of weakness for Home Depot over the last several quarters. And one of the reasons for that is because these are projects that tend to be financed. So when you have borrowing costs as high as they are now, that's something consumers have put off. So I think in order for that to come back more robustly, you're going to need to see rates come down a little bit.
Drew, a few weeks ago, executives at Home Depot were talking about how some consumers are signaling that this rate environment is the new standard. So do you think there's going to be more appetite for consumers to say, if this is the new standard, at some point, I just got to pull the trigger, get on the property ladder, or do that big project?
Yeah, I think at some point that may be the case, but I think what we're dealing with now is it's not just the high rates that we have. I mean, mortgage rates are back up above 7%. But what we've heard from the housing space more broadly is increasingly cautious consumers, just over the general direction of the economy. Maybe they're more concerned than they have been about their job security. So I think when people are thinking about taking on such a large purchase, whether it's purchasing a home or undertaking a large-scale remodel, there's a little bit more hesitation out there right now. So rates are certainly the biggest component of that, but I think that this consumer sentiment shift that we've seen over the last couple of months is certainly playing a role.
Drew, appreciate the update, sir. Drew Redding there of Bloomberg Intelligence on Home Depot. This line in our story this morning, about 80% of Home Depot's customers own homes, which speaks to the thinking of your questions a moment ago.
And this is the reason why they tend to do well when rates are high and people have to make do and make sure that the caulking is solid so they don't get mold in their bathrooms. Not that I'm speaking from personal experience, or, potentially just make sure that their handles aren't falling off certain fixtures and things of that nature.
I'm pleased you broke down the numbers on a serious point. Do you remember on China it was diversify, not decouple? They've diversified, haven't they?
Yeah.
In a massive way.
And it's been a real kind of boon to them in terms of how much they can absorb some of the price shock. You do see margins. The full year operating margin is expected to be 13%. The estimate was 13.3%. So a little bit in on that front. But other than that, they said they don't expect to have to raise prices that much. And it speaks to their ability to do that given the mix of products.
Need some fresh homeowners. Need those rates to come down. Home Depot up by a little more than 3%. I know you feel totally fine.
Yeah.
We know your position. Don't worry.
Yeah, but I need coffee.
And your 2% mortgage and all of that. OK, not bitter at all. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Israel allowed aid trucks to enter Gaza yesterday for the first time in 3 months. But shortly after Israel announced their entrance, the UK, France, and Canada issued a joint statement calling the aid wholly inadequate. They threatened concrete actions against Israel, including sanctions for its activities in Gaza. Meanwhile, the Chinese government has accused the Trump administration of undermining recent trade talks in Geneva. The Commerce Department said it was issuing guidance to make clear the use of Huawei AI chips anywhere in the world is a breach of the U.S. government's export controls. China considers this a discriminatory measure and demands correction. And the Department of Justice has opened a probe into a recent breach of Coinbase. Sources telling us here at Bloomberg, investigators, including those in the department's criminal division, are digging into the circumstances surrounding the breach. Coinbase said the hack involved criminals bribing employees and contractors to obtain client data. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, the best bonds in the world.
American bonds are the best buy in the world. They're going to be even better buy once all of our policies are replaced. We support what it takes to get the bill through.
Up next on the program, Priya Misra of JPMorgan Asset Management, live from New York. This is Bloomberg. Live from New York City, welcome to the program. Equities just a little bit lighter this morning. We're down by 0.25% on the S&P 500, following a 6-day run and a gain of more than 5% over that period. If you turn to a single name in the pre-market, Home Depot doing okay. Sales came in a little bit light, but we're putting so much weight on the outlook, the confidence that any company can display at a time of high uncertainty, let's put it that way. The guide, they reaffirm the guide. The stock is higher by more than 3%. That's the stock market story so far this morning. Let's turn to fixed income. Under surveillance this morning, the best bonds in the world.
I think that American bonds are the best buy in the world. They're going to be even better buy once all of our policies are replaced. And this downgrade is something that happened because of the runaway spending of the previous administration. They were the last agency to move, and I don't think it should be a surprise to markets. We support what it takes to get the bill through.
So here's the latest this morning. Traders looking past the latest US credit downgrade and focusing on the tax debate on Capitol Hill. Priya Misra of JPMorgan writing, the tax cuts will get extended and the spending cuts won't likely happen. Fiscal term premium should rise more, steeper curve, higher cost of capital to create dispersion in growth and returns. Priya's with us around the table. Priya, good morning.
Morning.
How much risk is in the so-called risk-free asset?
So it depends on what you define by risk. Credit risk, there is no credit risk. I mean, the US issues fiat currency, we will pay back our debt. The duration risk, which is really a function of term premium, or I don't want to bond geek out here, but risk premium, that's much higher. So you're looking out the curve. There's a lot of risk in those 10-year, 30-year bonds. You look at Japan. So I think if there's a global rise in rates, if we're ignoring, I mean, I think the whole Moody's downgrade, we knew about it. It was lagging, I hear you, but, you know, in the words of Hemingway, you know, how do you go bankrupt? And not that I'm saying that the US is going bankrupt, but, you know, it's gradually and then suddenly. And I think, are we at that point where the market says, you know what, we have to look out for fiscal sustainability. Congress is not doing its bit. So the bond market has to force Congress to do its bit. And so I think that's why the long end is scary, because how high do rates have to go before the administration or Congress says, you know what, we don't have the political will, but the market's forcing our hand. I'm not sure what that level is. I don't think the bond market is very beautiful right now. It's in the yippee state. So, you know, that's why I think when you ask about risk, the long end has risk. The front end is being dragged with the long end. That's where I think there's opportunity, because I think, I mean, we're trying to move away from trade, but we're still in that pause. Effective tariff rate is still high. There's uncertainty. I think the Fed will be late, but at some point they're going to cut a lot, more aggressively when they start. So the front end, I like. The long end, that's where that risk comes in.
Let's unpack some of this. You used an important word, global. It's global. What's making it global at the moment?
So some of it is, I think, US rates do tend to drive the rest of the world. I think there's some element of that. We've seen it in other, you look at the taper tantrum. Even when it's a US domestic issue, you do see that impact because investors are global. But the other thing is the rest of the world, if the US is forcing the rest of the world to do more fiscal stimulus, either because of trade, defense, you name which issue, you're going to have a lot more supply in the rest of the world. And then if I'm a foreign investor, I'm Japanese, I can look at the highest Japanese rate, or I can look at the US and say, you know what, I don't even know what's going to happen with the dollar. Maybe the dollar is still overvalued. I'd rather hold the US. So I think when it's a global rate rise, it does tend to have more legs, which is why that, to your risk question earlier, that risk in the long end is higher because this is a global bond sell-off, and I wouldn't fade that. I don't think there's a cross-market trade here. I think it's a steepener trade globally.
Well, just to build on that, and something that Ed Yardeni was talking about, how global bond vigilantes are grabbing their pitchforks and marching into the streets and pushing back against some of the fiscal stimulus and just some of the recklessness, as some people would say, that these developed markets have been with their budgets. How much does the risk, if you will, really lie in the developed markets in a new way in sovereign debt markets that totally upends investing logic of the past couple decades?
I think it is a developed market issue. And I think some of this goes back to, if you see how much fiscal stimulus happened during COVID, it was much more in the developed world. Now, it was not as much in Europe, but we're going to get a lot more defense spending, infrastructure spending. But the US spent a lot of money. Part of that exceptional story was the fact that we had significant fiscal expansion. And now I think the market's saying, no mass. What I struggle with is risk assets are ignoring this. So if things slow down, the Fed is telling us actually very clearly that we're not going to be in there quickly. We might be constrained because of inflation risk. Now the fiscal side's telling you there may not be a lot of fiscal put either. So I think the risk asset complex is a little complacent. But to your point, I think the bond vigilantes are awake. Do they take over? I think it's a bit of a dance between the hard data and the bond vigilantes, and we have to see who wins.
I keep thinking about Ed Yardeni, and he can't decide whether it's going to be a stock market melt up or a bond market meltdown. And it seems like the risks right now are the potential for ongoing growth, also with inflation and fiscal irresponsibility on one side. So the duration risk is the big one, or it becomes a growth scare. And suddenly the credit risk becomes the key component. Are you saying that the credit risk component, the growth scare, is the one that we should prioritize, which will ultimately cure the other side, at least for most of the duration, in terms of where the risk is perceived?
I think that's like the trillion-dollar question here. I mean, the hard data is going to be so muddied by front-loading. Maybe there's still front-loading happening because we're in that pause period. We're in an uncertain period. I do think if I step back and look at fundamentals, I think we're slowing. We've taken that tail risk of recession off the table. But what is our base case? Below trend growth. And so I do think if you ask me to pick one, I would say the growth side is likely to continue to weaken. We'll be looking at details. Do companies pass on? I mean, this is a consumption tax, ultimately. Whether it's corporates eat it or consumers have to eat it, it's going to start to hurt demand. So I think growth slows down. But to your point, I don't think we can ignore if we get a bill, and it's still not done. The Senate has to work. I mean, I'm focused on the Senate. They don't like even the Medicaid work requirements. So if you get SALT, you get a lot more fiscal stimulus, and we realize it's all front-loaded. Then I think you can get that long end. But there is a self-limiting aspect to that long end. Like, I don't know if it's 4.5%, 5%. I think every other market's going to pay attention to it. The economy is going to slow down because the long end is what actually drives the economy. So there's a limiting aspect. I just don't know if we're there yet. And if the hard data remains muddied and all we get is the soft data, hard data disconnect, you can get the front end being stuck and the long end taking over. I think that's the risk scenario, which is why it's nervous to be in the long end. I think you're supposed to have steepeners. And if you own risk assets, you're supposed to buy that front end because that's the only place where you can have confidence that the Fed can come in and somewhat control.
Priya Misra of JPMorgan Asset Management. Priya, thank you. A lot to think about in fixed income. Your 10-year. Lisa, this morning at least, 446.
A lot of people do believe, just to echo what Priya was saying, the self-limiting factor of some of the increase in the long end, that ultimately at some point you need a response either fiscally or you need a response from the Fed and just to slow down in the economy. That's really the question, though. What is that level? And we just don't know.
The move back in 23 forced corrective action. Ed Yardeni was talking about it. They changed the maturity profile. They reduced duration at Treasury. You can't repeat that act twice, can you?
Well, I mean, you can kind of continue it, but no.
Get the Fed to step in and borrow the bills.
Oof, that's going to be something. Oof.
Coming up next, Joe Amato of Neuberger Berman, former World Bank President David Malpass, Torsten Slok of Apollo, and Daleep Singh of PGIM Fixed Income. Live from New York, this is Bloomberg.
There have been sell America periods or periods of enthusiasm around selling America in the past.
The rest of the world now has other places to invest. We're unwinding globalization.
The global growth picture isn't particularly positive.
I think there is an environment where the US exceptionalism in trade can just make a little comeback.
The bill that's about to go through will raise it by trillions more. And at some point, there's a day of reckoning, and that US exceptionalism is tied to that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
6-day winning run on the S&P 500, live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures pulling back just a little bit on the S&P. We're negative by just 0.2%. On the Nasdaq, we're down by 1/3%. Yesterday, we heard some calls to buy the dip from Max Kettner of HSBC, from Mike Wilson of Morgan Stanley. We asked what dip. Apparently that dip was 1% because we wiped it out pretty quickly yesterday, didn't we?
I thought it was just hilarious. We were kind of almost mocking, almost flippant. This is no dip. We saw a 5% gain last week in the S&P. We saw a 9% gain in the Magnificent Seven. 1%, what is that? Evidently, that's a dip, and it's buyable, which gives you a sense that there is a bias in this market to the better case scenario, not just among investors, but also among corporations who are taking a lot in stride and saying, you know what? This is sort of a temporary thing. We'll figure it out.
That dip was bought very quickly in yesterday's session. Attention's going to turn to this a little bit later on this morning. The president heading down to Capitol Hill to rally the troops, get the Republicans to unite behind his big, beautiful bill.
The Republicans in the House. This is why this is so challenging. It needs to first get out of the Rules Committee at 1 o'clock in the morning on Wednesday, and then Speaker Johnson could put it on the House floor. Will enough be given to the deficit hawks, to the SALT caucus, to those that want to make sure that Medicaid, there's easier access, and they don't want to see some of those restrictions put in place, for all of them to come and vote for this bill? And then it goes to the Senate, which has its whole host of problems. So I know that the president is going there potentially to be the closer on Capitol Hill today, but I think the next few weeks and months, he's going to have to make a few more trips on the other side of Pennsylvania Avenue.
I love what Punchbowl talks about, the sort of existential fight for Trump republicanism. And it comes at a time where you have a president who loves debt. He loves the long end. He wants to see that long end, big, beautiful long end, go down. He also wants to see his big, beautiful bill passed. And you have a lot of people who are getting yippy, as Priya Misra was saying, because ultimately something doesn't add up in a way that's making people comfortable. So how do you cross all of these T's at a time where clearly there is great unease? And that, I think, is going to be the really interesting test.
Yeah, yesterday this bond market didn't look so beautiful. This time yesterday. And then by the afternoon, this Treasury Secretary got what he wanted to see, which was lower yields.
Yeah, which is a comforting reality. At the same time, if you take a peek over at Japan, it gives you a sense that maybe not all clear on the global bond vigilante scale, which just shows, look, this is an ongoing concern at a time where, I don't know if they do have Bloomberg terminals over in Washington, D.C., but I highly recommend.
I've seen them. They
okay,
do.
All right. There are a couple of different tickers I recommend you check out on a daily basis.
So does Steve Myrick. I mean, he got on a call with reporters yesterday. He has this new paper out. He's going to be joining us in the next hour. He's talking about the tax and spending bill. And he mentioned when reporters were like, do you see what's going on right now on the 10-year and the 30-year? He's like, I don't know about you, but I just checked my screen. We're back to unchanged. So they were just trying to downplay what happened with Moody's and saying this is just temporary. It's a yip. It's involuntary minimum spasm like you get, I think, in golf games.
USGG 30YR.
Yeah,
is that what you were thinking?
I actually think that's the important ticker.
SOVM, good screen too. Just if they won the whole curve.
We should just change it to YIP, go. And I think that would be telling.
The good news this morning, no yips. Yields are up just a single basis point on the 10-year 4.46. Coming up this hour, Joe Amato of Neuberger Berman with stocks threatening to snap a 6-day winning streak. The former World Bank president, David Malpass, will join us with President Trump promoting his tax plan on Capitol Hill. And we'll catch up with Daleep Singh of PGIM Fixed Income as the White House looks to reassure bond markets. We begin this hour with stocks steady following a 6-day winning run. Joe Amato of Neuberger Berman has this to say: talk of a structural change in the global economic ecosystem is premature. Has capital been flowing from the US to other regions recently? It looks that way, but we see that as cyclical rather than structural. Joe joins us now for more. Joe, good morning.
Good morning.
Appreciate the framing, so let's build on some of that framing. I think it's important. Why do you see this as more of a shock to the cycle than a shock to the system, a structural shock?
Well, my comment was more about the question of American exceptionalism, which has been, a hot topic over the last number of months, and is that going to end? And I think the U.S. has still some very structural advantages in the context of the reserve currency, but there's going to be ebbs and flows of capital flows, and we see capital flowing outside the U.S., and that's one of the reasons why we upgraded global equities, particularly because of developed markets outside the U.S. seeing that benefit of the capital flows outside the U.S. But again, the U.S. still has some long-term structural advantages.
One thing we keep going back to is whether you believe that is a push or pull dynamic? Is that better policies elsewhere or bad policies here? Are we pushing capital or are we pulling it in?
I think clearly the catalyst was the tariff announcements and the overreach that clearly the administration did. So I think when you look at that and you're like, well, wait a minute, you're going to affect U.S. growth, right? If you're going to have higher inflation, lower growth in the U.S., let's think about where there are other opportunities and then look at the relative value of equities, in particular, outside the U.S. versus the U.S. That's what led to a lot of that capital flow.
Not to get too touchy-feely, but a lot of people come on the show and they say they travel around and they see the anger among Canadians. They see the anger amongst Scandinavians that are saying, whatever it is, sell. I don't like what they're doing. It's offensive to us. I don't like the way they're doing it. We're going to cut our exposure. Are you saying that that emotional response is in a small subset, that it's short-lived, that you could see some sort of knee-jerk feeling right now, but that longer-term profits will ultimately rule the day? What's your interpretation of that?
I happened to be in Canada on April 9th. And so it was an interesting couple of days visiting with our clients up there. And I think there was real frustration and confusion, really, was I think, the better word. But, I think that economics are still going to rule the day, right? So while you may get emotional, the Canadians are very good long-term investors, right? Their pension system is a fantastic pension system. So, I don't think they're going to get too caught up in the day-to-day emotion.
There is also this idea of redefining American exceptionalism, that once it was in the bond market and the currency market, and now it seems to be transforming into an equity play more than anything else, particularly with tech dominance, really leaning on some of the big tech names. Do you see that as happening, that you could see a divergence with ongoing questions around American exceptionalism and debt and currency, while still seeing a pretty steady equity market?
Well, I think that exceptionalism really is driven by the innovation culture we've got here. And is not just tech. Because if you look at companies in the industrial sector, financial sector, other sectors, they're driving forward in innovation using technology certainly as a tool for that. And I think that gives the U.S. economy a really long-term, significant competitive advantage in that ecosystem that's been built up over decades and decades and decades, right? We treat capital well in the U.S., and reward innovators, where that's not necessarily the case in a lot of other parts of the world.
That's why it attracted a higher multiple in this market versus the rest of the world.
Yeah.
Has that story changed, given everything you just said a little bit earlier?
Well, interesting. If you look at the relative multiples, let's say Europe versus the U.S., in tech, they're valued about the same. The tech sector in Europe and the tech sector in the U.S. is valued in the high 20s multiple. But you see a premium multiple in many other sectors in the U.S. versus Europe because those companies have adopted that innovation and technology that's going to lead them to a higher level of growth, even if you're manufacturing goods or automobiles or what have you.
There's another way, just to build on what John was asking. How much do yields where they are and this question around some of the debt sustainability start to constrain multiples in a way that is, despite that innovation? So you could see sort of a cap on how much you could gain in U.S. equities, regardless of that innovative spirit.
Yeah, I mean, we're certainly looking very closely at the bond market, right? That's what drove the policy change on April 9th, the weakness in the bond market, and the administration should be very focused on that. And from an equity investor standpoint, the foundation of risk assets is in many respects the 10-year, because you price your risk assets off of that. And looking at that closely is something that I think is going to drive equity multiples. You see the 10-year approach 5%. I think that starts to bite into where multiples are in the U.S.
When you talk about this bumpy road, unpredictable future because of tariffs, do you feel like a lot of the uncertainty has been put back in the bottle? Because the president has come out and had a détente with China and said, basically, we will be lowering rates, even if we're not in active negotiations right now with some countries.
Well, I think from a tariff standpoint, in some respects, the left tail risk has been reduced because of the China agreement of a weekend or two ago. But you still have an enormous increase in the tariff rates versus where we were just a short while ago. So that's going to have its impact on U.S. economic growth in our view. So, I don't think we've seen the end of this. I think that seeing how companies are impacted, you're going to see a bunch of retailers report this week, and you're going to start to see a little bit of maybe the early stage effects, but it's probably more so as you get into the third quarter. And it's something that we're still worried about. And I think right now, equity markets, you're going to be in a trading range, right? We had a strong bounce back based on a bit of good news with tariffs. You had hard data hang in there, so the resiliency was strong, even though soft data is sort of all over the place. But I think that's led this 20% plus bounce off the bottom. But I think right now you're going to be in a trading range until you see really greater clarity in the second and third quarters.
We've been trying to define risk all morning, and Ed Yardeni was talking about how he sees both the risk of a melt-up in equity markets and a meltdown in bond markets, and he really flip-flops between the two on a day-to-day basis. Between the two of those, which do you think is more likely?
I don't see a melt-up in equity markets at this stage. So I would probably lean in favor of worries about the bond market and the long end of the bond market, given the debt sustainability questions. Because, it's one thing to, if you look at your real rates and your inflation expectations, but it's that term premia that can really move and move hard. And bond markets, you'll blink. And if you're at 5% plus and the 30 years at 550, equity markets are going to be destabilized.
That won't be a great morning if that happens, that's for sure. Priya Misra of JPMorgan Asset Management echoing some of those concerns. The good news this morning, yields are higher, but only by 2 basis points. The 30-year at 492. Speaking of JPMorgan, some scathing words from Jamie Dimon yesterday at Investor Day. People feel pretty good because you haven't seen an effect of tariffs. The market came down 10%, it's back up 10%. I think that's an extraordinary amount of complacency.
There is this feeling that you do see 3 times the level of tariffs or more. It is a very different reality. Jamie Dimon has also taken a real stand as having the premier risk management position. He tends to show that the House of Dimon will remain stable no matter what. There could be lots of risks out there. Treasury yields could go to 10%. That will still be standing. So how much that's a market call versus raising questions around how to be a risk manager are two different things.
Would you call it an extraordinary amount of complacency in the equity market and the return trip we've had?
I think there's some complacency in the bounce back. I mean, you've bounced hard off of those lows, as I referenced earlier. So I could debate extraordinary because I know how our portfolio managers are thinking, and they're sitting there, very anxious about the upcoming impact from tariffs. So I wouldn't say extraordinary complacency, but I think, again, you're going to be in that trading range because of that bounce back.
One heck of a move off the low, a rally of almost 20%. Joe, this was great. It's got to catch up. Appreciate your time. Thank you. Joe Amato there of Neuberger Berman. Equities at the moment down by just 0.2% on the S&P 500. Following a 6-day winning streak, we just pulled back just a touch on the S&P. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Anand. Hey, Yahara.
Hi, John. President Trump held a 2-hour phone call with Russian President Vladimir Putin yesterday. Following the call, he said on social media that Ukraine and Russia would, quote, immediately start negotiations toward a ceasefire. Trump said the U.S. would not participate in the talks, but didn't rule out further sanctions on Russia. Meanwhile, Wall Street strategists are betting on Europe. According to strategists polled by Bloomberg, the stock 600 is expected to end the year above 550 points, which is a 1% gain from Friday's close. JPMorgan Chase has one of the highest targets at 580. The difference between JPMorgan's European and U.S. targets suggests the stocks will outperform the S&P by 25 percentage points. And Chinese shipments of iPhones and other mobile devices to the U.S. fell to their lowest level since 2011 last month as the impact of President Donald Trump's tariffs hit the sector. Customs data showing smartphone exports slid 72% in April to just under $700 million worth, sharply outpacing the overall 21% drop in Chinese shipments to the U.S. That's your Bloomberg Brief. John?
Yahara, thank you. That's the air pocket people are worried about that they might see in the data in the coming weeks, that's for sure. Up next on the programme, the president pushing his big, beautiful bill.
Looking to get the one great, big, beautiful bill that will be the greatest tax cuts in history. If we don't get it, that means the Democrats will have stopped us.
That conversation just around the corner. We'll catch up with the former World Bank president, David Malpass, live from New York City this morning. Good morning. Live from New York City, welcome to the programme. Equity futures just a little bit softer. We're down by 0.2% on the S&P. The attention shifting very quickly away from the downgraded from Moody's going into the weekend. The attention very quickly on this, under surveillance this morning. The president pushing his big, beautiful bill.
Looking to get the one great, big, beautiful bill that will be the greatest tax cuts in history. If we don't get it, that means the Democrats will have stopped us, and that means people will get a 68% tax increase, the largest in history. And if we do get it, we're going to have the largest tax decrease in history.
So here's the latest this morning. President Trump heading to Capitol Hill, hoping to persuade GOP holdouts to get on board with his massive tax and spending bill ahead of House Speaker Mike Johnson's self-imposed Memorial Day deadline. Bloomberg's Tyler Kendall joins us now for more. Tyler, if this isn't passed by that deadline, whose fault is it?
Yeah, hey, John. Well, Republicans really are the ones that are on the hook for this because they're choosing to do this through reconciliation, which ultimately means that they don't need to negotiate with Democrats, but they do need to negotiate with themselves. And the numbers are pretty tricky at this point. Once the bill gets onto the House floor, House Speaker Mike Johnson can only afford to lose 3 Republican votes. And we already know one firm no. That's Thomas Massie of Kentucky, who says that he will not vote for anything that's not at least deficit neutral. And we are, of course, a very far away from that. So at this point, President Trump is really going to try to urge these lawmakers to overcome their differences and at least advance the bill, since it's just going to come back with changes from the Senate anyways. But at this point, there really isn't indication that any of them are going to start to let up when it comes to their policy position, since many of these lawmakers say that this opportunity to remake taxes and spending cuts doesn't really come up all that often. So we're really going to be watching closely, of course, John. While most Republicans do agree about the tax cuts at the heart of this package, there's still some really big disagreements here about the way forward when it comes to potential changes to benefit programs like Medicaid and what's going to happen to lifting that SALT cap.
Well, let's talk about SALT. They met yesterday, the speaker with a bunch of Republicans from New York, and no deal, Tyler, came out of it. What's the sticking point right now?
Right, no deal, Anne-Marie. The sense is that one of the proposals is still on the table, that 40-80 proposal, which would lift the SALT cap from $10,000 to $40,000 for individuals, and then you can double it for married couples. But really what fiscal hawks need to see in order to get on board with lifting the SALT cap in a more meaningful way are those revenue raisers or spending cuts to offset them. And fiscal hawks at this point have said that they're going to actually put that on the SALT caucus to find those savings. We heard from one such member, Republican Congressman Nick LaLota of New York over the weekend, who suggested that perhaps they could snap that top tax bracket rate back up to 39.6% from the current 37% by letting the 2017 tax rate expire, and that could potentially produce, he said, about $300 billion worth of savings to account for this SALT cap. So we're going to have to wait and see exactly how this ends up evolving. The other hand-in-hand thing that we're watching here is what's going to happen to Medicaid. Of course, we know that there's a few different proposals on the table there, including moving up those work requirements.
Tyler, thanks for the update. More from Tyler later in the program as the president heads down to Capitol Hill. Joining us now here in New York City, the former World Bank president, David Malpass. David, good morning.
Good morning, John.
More than a decade of warnings. August 2011, Standard & Poor's. August 2023, Fitch. May 2025, Moody's. We've ignored them for the best part of a decade. Should we start paying attention?
Absolutely. The fiscal situation is a real mess. I've written about it, that the spending is out of control. So the question is, how do you bring control to a Washington that really wants to grow? You know, the lobbyists right now are in seventh heaven because of the complexity. And so you have this system that is able to borrow and tax like crazy. And so then Washington sees that and says, we should just spend double whatever we can bring in. And that's what they're doing. Now, whose fault is that? Everybody wants to point fingers at everybody else. I think we've got to see a fundamental change in the spending system. DOGE started that. And now this reconciliation bill is the extension of that and enactment into law. Notably, it includes regulatory reform, which is going to help a lot with growth.
But David, until Washington decides to go and really look at Social Security, that's the biggest piece of the pie when it comes to the spending. Really, everything else is on the margins. Is this administration willing to go there?
I don't think so, and I don't think they should. I think you have to build credibility with the public. Why would you go after Social Security? People put their money into it, and then retirement is a really important part of people's lives and their children's lives as they watch their parents.
But shouldn't the age be raised?
Don't do that.
Shouldn't the age be raised for Social Security?
I don't think it's timely for that question to come on. You really have to show that you can cut some programs, downsize government, and set up a system where you actually make decisions. So they're arguing about the fraud and waste in Medicaid. I think that's a useful discussion of how can you get quite a bit of savings from a program that was expanded drastically.
You talk about how this administration has to have trust with the constituents. Well, the president promised a number of policy provisions on the campaign trail, lifting the SALT tax, which was capped under his first administration, making sure that things like he did say he doesn't really want to touch Medicaid, definitely doesn't want to touch Medicare. How do you build that trust if these are some of the issues that are on the chopping block?
I think by going to the Hill and talking with members, but then also clear communication from the administration and from all around the country of people saying we want the government to stop spending so much money and then make decisions and I've advocated start with small decisions and then make them bigger and bigger. Sometimes I've talked about it that you need to make 3 major spending decisions per week all the way through 2025. And so I think they're doing that some in this reconciliation bill. It's really long. I don't know if you've looked at the bill, but it's intensely complicated.
Well, you talk about that and how it's a daydream for a lot of lobbyists. I am wondering if you speak to people in Washington, D.C. and get a sense of what kind of constraint bond yields are at a time where bond vigilantes are getting very excited.
I think that was the big issue at the beginning of the Clinton administration. You know, spending had been growing, and so you had the idea that I want to be reincarnated as the bond market because it's so important. I do think we've changed a lot since then. For one, the Fed is buying lots of bonds, so that changes the dynamic in the bond market. The U.S. economy is fundamentally really strong, and so I think we could have lower interest rates on the short end and the long end if they could begin to think about the spending side and actually pull it down. So I'm not one that thinks there's so much a limit or a higher yield that we're going to have to see. I think more we have to see the growth come out of the regulatory changes.
How much are you advocating for monetizing the debt in some capacity, given the fact that the Fed is buying bonds, albeit at a slowing pace, and has been known to do that?
You know, I'm not a fan of QE. So since the beginning, I've said it was a shift in duration. The government was basically buying duration to cover up the lack of growth. And that took us from 2010 all the way through 2021. So a giant problem. But that it's correctable. It's not a big step for the U.S. Fed to say it's going to downsize its portfolio. That would reduce that problem. That's already going on in Europe. Look, the ECB is selling off its bond portfolio or reducing the size of its portfolio fast, and it hasn't hurt their yields. And so I think that's a lesson. So that shouldn't be the issue. Right now the issue is the Fed is huge. It's doing regulatory control. It's not talking much about spending. It didn't talk during the Biden administration about the blowout in spending, and the interest rates as a result end up being higher than they should be. The models within the Fed are not working at all. They're based on their 50-year-old models, economic models of how the economy works. So that needs to be really rewritten.
It's been ridiculous for quite a while, running a 6% budget deficit
thank you.
with unemployment close to 4%. Just absolutely ridiculous.
And everybody knows that, and then they say, well, my politicians should stand up and go after Social Security. That's not really the answer to me. You've got to make
suicide.
Name programs that we don't need, the public will support that, and then build on it. And there's some of that in the reconciliation bill. It's good to have President Trump engaged on it.
David Malpass, it's good to see you, sir. As always, as David said, the system is so large in Washington. You start to push against it, it pushes back pretty quickly.
And that's the reason why we've seen year after year people say the same issue and never remedy it, because it is political suicide.
Coming up on the programme in just a moment, we'll catch up with Torsten Slok of Apollo on what he says is a growing list of US economic headwinds. That conversation is just around the corner. equities just a little softer this morning. Live from New York City, good morning. We look like this. We're down by 0.2% or so on the S&P 500. Similar move on the Nasdaq. No drama whatsoever with 2 hours until the opening bell. Let's get you some morning movers this morning. Let's do that with Yahira. Hey, Yahira.
Hi, John. We start with Home Depot kicking off a big week in retail earnings on a positive note. Shares are up 2.2%, even though sales came in light. But as you mentioned earlier, it's all about the confidence, and that's what's propelling this stock, because the CFO says they've done the work when it comes to diversifying sourcing, so they won't need to raise prices in the face of tariffs. And looking ahead, they plan to diversify even more, saying no country outside the U.S. will make up more than 10% of its purchases. Next up, we have United Health. Those shares also rising in the pre-market, up 2.4%. Of course, this stock had been badly beaten down, especially after the Wall Street Journal reported it was under criminal investigation. But there's a vote of confidence by the new CEO and CFO, both buying about $30 million worth of stock. And it's a mixed picture when it comes to the Mag 7, but I've got my eyes on Alphabet. Those shares are up about 0.5% ahead of its developers conference, which begins today, where it's expected to showcase its latest advancements in AI. That matters because Alphabet stock is down nearly 12% this year, and investors are hoping that this event sparks a turnaround at a time, of course, when there are concerns that it's losing its market dominance. John?
Yahira, thank you. Appreciate the update. More from Yahira in just about 10 minutes' time. On our radar this morning, President Trump heading to the Hill to unite the GOP behind his big, beautiful tax bill. Sticking points like Medicaid cuts remain ahead of Speaker Johnson's self-imposed Memorial Day deadline.
Very challenging right now for him. He's really walking a tightrope. And you could see that yesterday. Talks break down on SALT, and then Chip Roy last night, one of these individuals who voted present, but he's on the Rules Committee as well, so he could vote no 1 a.m. on Wednesday. He took to Twitter and said raising the federal deficit inflation to subsidize blue state SALT top 1% liberals who keep electing politicians to raise their taxes and mismanage their states is not appealing. AKA, if you continue to lift the SALT tax, I don't think I'm going to be a yes when it comes to this bill. And that is why this is so challenging. The second you give a concession to one group, you have a host of problems with many others.
We've all been talking about what the goals are, and what the goals are really important. And right now, it's unclear as President Trump heads back to try to whip everybody into some sort of order, what the goals are going to be. Is it going to be the SALT tax deduction and the cap maybe getting lifted? Is it going to be some of the no tax on tips, or is it going to be the cuts that really underpinned a lot of the Republican platform for so many years?
As Annmarie said repeatedly this morning, this is only herding one set of cats. Once you've heard these cats, you've got to herd another set of cats over in the Senate.
And you're already hearing from them, individuals who don't want to see Medicaid touched at all. They don't want to see the requirements changed. Individuals like Tom Tillis of North Carolina, who companies flood into North Carolina during the Biden administration, set up solar plants, set up battery plants. They need those grants. They're saying, we already have told these companies this is going to be the path of travel. You can't just take them away. Whole host of issues once they get through the House to go back to the other chamber.
We've moved on from trade quickly. We need to get back to trade quickly. China is accusing the Trump administration of undermining recent trade talks after the U.S. Commerce Department said global use of Huawei chips would violate U.S. export controls. The agency recently stripping the anywhere in the world reference from its guidance.
So this is really challenging, and so is how fragile the relationship is right now from Washington and Beijing. This comes from the Commerce Department last week saying that you can't use these chips, and they think potentially using these chips were made by going around U.S. export controls. It came at a time when the United States is allowing the Gulf, this all happened last week, to buy more U.S. chips, but they need to make sure that the tech does not leak to China. And they're basically telling all these geopolitical swing states, if you're going to use our chips, you can certainly not use China's.
This was always going to be a sticking point. Just to stick on trade and stay on that theme, Subaru is raising prices for several of its models. Reuters reporting the automaker says the price hikes are due to, quote, you'll love this, current market conditions, without citing tariffs or any other specific price actions.
Well, someone got McKinsey in finally after the experience with Walmart. You mentioned tariffs and the hammer comes down of the truth against your company. This is what we're going to hear quite a bit, the idea of market conditions. How do you absorb extra costs, macroeconomic uncertainty? These are the types of code words that we can expect going forward. We still have, of course, Lowe's and Target reporting earnings later this week. We did hear from Home Depot. And how much are we going to hear this from companies kind of gloating about their very domestic domestic supply chains and talking about how that allows them to keep prices pretty much stable. But yeah, you can read between the lines. I don't think it takes a genius to understand exactly what those, macroeconomic pressures are.
They're going to have one of those commercials too, that all the other automakers are doing. This is where we're based in America.
Exactly.
We're an
Huge
American company
flag.
with thousands of employees.
Yeah. Subaru going through the mud.
So who's
People being
making
like,
money at the
"Ooh."
moment? People who put ads together and McKinsey. Is that who's making money at the moment off the back of all of this?
I think that probably you could throw a couple to all of the different PR firms to try to make people look very, robust.
Subaru adding between $750 and something like $2,000 to vehicles depending on the model and trim, according to this report from Reuters and to a notice post on the dealer website. Expected to hit vehicles on dealer lots starting in June, so look out for that. Let's stick with the economy. Torsten Slok of Apollo writing, the list of headwinds is growing. The trade war is making products more expensive in Walmart. Student loan payments are restarting. And the Moody's downgrade is pushing up borrowing costs for consumers and for firms. Torsten joins us now for more. Torsten, good morning.
Morning.
A lot to worry about. And Fed officials just told us to take summer off, basically, that they'll get back together in September and consider what to do. Do you think they need to do something before then?
I don't think they need to do anything before, but I do think that the list of worries is indeed growing. It used to be the case for the last several months that we've been worrying mainly about the trade war. What is coming from the trade war, very importantly, is what Jamie Dimon pointed out yesterday, namely that now we're going to see the negative effects of tariffs on earnings and therefore also on the economy. The Yale Budget Lab is quantifying that the impact on GDP this year will be minus 0.7. Normally, GDP growth is 2, so if I subtract minus 0.7, that brings me to still 1.3. That's not a recession, but it certainly is something that will be pushing the unemployment rate up in the same calculation by roughly half a percentage point. So the first thing is tariffs. We are still waiting to see the actual effects of tariffs, both on earnings and on the economy. And the things that are being added now more recently is student loan payments are restarting, is beginning to hit people's credit scores. There's about 9 million people now who potentially will have a hit to their credit scores and therefore will have challenges going out buying a house, going out buying a car, going out buying a washer and dryer. And third and finally, the downgrade. Yes, the market reaction yesterday may be more mild. And yes, we did go from the US being hyper-exceptional to just being exceptional. But it's certainly a risk with the fiscal discussion and in rates markets that we are also adding on to the layer in terms of the issues that we're talking about.
You see this stress in the buy now, pay later data as well. And you've seen that build for a number of months. The question I would ask, the brutal reality is, low-income workers haven't had a good run for a long, long time. That's been true even when people came on this programme and said the economy was good. Do you see the stress migrating up income levels at all?
That is exactly what's going on. So you saw Klarna yesterday say that they were reporting that buy now, pay later was seeing more weakness among consumers. And the issue is exactly that it's migrating up towards middle-income households. You're seeing this also more broadly in, for example, in the housing data. The Sonda weekly data for traffic for home builders is beginning to slow down. And this spring selling season has basically been much weaker than the spring selling season we've seen for the last few years. So also the weakness in the housing market is a leading indicator telling you that the middle-income consumer is also beginning to look more stressed.
So you don't necessarily see recession, but this downside to growth that comes at a time of pricing pressure, something that looks a bit like stagflation. And I wonder, some people say, well, if it's not a recession, then it's pretty good. Is this actually a worst-case scenario for risk assets because there isn't a very obvious reaction function from the Federal Reserve, from policymakers, to respond to the fundamental underlying weakness in consumers?
Exactly, because inflation, if that is now going up, we've heard all the stories from Walmart, now Subaru, various, of course, retailers are saying prices will be moving higher over the coming quarters. That's what everyone expects. This is the textbook definition of a trade war, namely higher prices because imports of containers that come in to Los Angeles, of course, things will become more expensive. And that is exactly challenging the Fed's room for maneuvering because they will have to keep rates higher for longer in response to almost no matter what growth is doing. If growth, of course, gets into a deep recession, they will be cutting. But if growth is just weakening, and that is the expectation from the consensus, that's what we're seeing in the data, then you will have this stagflation situation, which is very uncomfortable from a Fed perspective because inflation higher for longer says the Fed should be hiking, but growth slowing down says the Fed should be cutting. So this becomes a question for the Fed. Do they like apples and oranges? Do they put more weight on inflation being high, or do they put more weight on growth slowing down?
So it goes to something that John was talking about. Jamie Dimon yesterday talking about this complacency in markets, particularly with risk assets, given the fact that, yes, you have these tariffs, but you also have this kind of backdrop that does pressure the consumer. Do you think that risk assets really are not pricing in this type of backdrop at a time when you've seen big rebounds in this wake of any kind of sell-off?
I think the stock market is backward looking at the moment. The stock market is not taking into account the fact that we have these three different forces that are now pushing the economy down. First of all, we have tariffs weighing on earnings, tariffs weighing on GDP, tariffs pushing the unemployment rate up. We have also student loan problems that will hit people's ability to borrow. And finally, we also have the Moody's downgrade. Yes, again, that might just be a thing in markets where we said, oh, this just went and came away and all of a sudden it's no longer an issue. But it is certainly something that this conversation, the direction of travel when it comes to the fiscal discussion, is only one way, namely that we will see debt levels go up. And there's more and more discussion around what does that mean, not only for rates, but also for the dollar. And note also yesterday, by the way, that the dollar went down, even though rates went on a round trip, still telling you that there is something here to think about in terms of the bigger picture, not only in terms of what rates are doing. And then when the dollar goes down, of course, we get even more inflationary pressure, and that complicates the job for the Fed even further.
Torsten, you keep talking about downside risks. Do you see any upside risk to policy proposals right now in Washington?
I do think that the stock markets focus on deals when it comes to trade deals. We do see, of course, that there could be some good chance that we could get some deals, of course, over the coming weeks and months ahead. But the issue here is that the policy has already been implemented. Let's not forget
but it's that on pause.
But average tariff rates went from in January 3% to now 18%. So that's a fairly dramatic shock. Remember in 2017-18, in Trump's first term, tariff rates went from 2 to 3. And now we went from 3 to 18. That's a very significant impact, which is exactly why this earnings season gave this outcome that companies are having a hard time giving forward guidance. Companies are having, of course, a lot of challenges with dealing with higher tariffs. That's why Ford Motor Company had losses of $1.5 billion, Apple losses of $900 million. It really is significant how these coming motions of what will happen to earnings and GDP are not being priced into markets at the moment.
In your office, at your headquarters, on the calendar, what's circled? What dates? Which month?
So what's most important is back to the square, the circle here to what you said about the Fed meeting. It is very important how the Fed communicates about this. So far, FOMC members have said we have a wait and see mode because it's fair to say, John Williams said this and Powell also has been talking about this, it's fair to say let's wait and see what the data actually is going to turn out like. But if I turn on my Bloomberg screen and type ECFC, go and look at what is the consensus expectation to inflation this year, it's going up. What's the consensus expectation of GDP growth? It's going down. As an investor, this should be the number one thing to look at when I do asset allocation. So the answer to your question is the incoming data, does it play out as the consensus and the textbook would predict, namely that inflation is going to go up and GDP is going to go down? And I would expect that is exactly what we're looking at over the next several quarters.
Inflation short-lived or persistent? They say they need time. New York Fed President John Williams said maybe by September. Is that enough time to know whether it's one and not the other?
Well, hold on. So there are two very important aspects of that. Beth Hammack said in a speech here 2 weeks ago at the Hoover Institution that she is already seeing companies that are not impacted by tariffs also raising prices because competitors are raising prices. And the second thing also, let's think about it the following. If it ends up being the case that you will have imports that are significantly lower and therefore you will have less variety on the shelves, that means that I may not be able to buy a white shirt and a right color. And if that's the case, then the price of all the shirts that are left will be going up. So that means that it's not only about this one-time lift in changing the sticker and what is the price of my shirt, but it's also that if there is less variety, if there's less goods coming in, and if we're trying to avoid and prevent goods from coming in, it will mean that the goods that are left might see a more permanent increase in inflation. So that's why this is not just a temporary feature in terms of thinking about inflation. It is something that potentially could have more longer-lasting impact.
Just don't buy a grey shirt. Can't stand a grey shirt. You notice that?
White or blue?
When men wear grey shirts, I just find no one makes a grey shirt look
it's
good.
It's because your ties are grey.
No one makes a grey shirt look good. It's not the tie colours. Sometimes just like white shirts look sharp.
Just a little
that
bit
light
dirty,
blue looks sharp. Precisely.
It's sort of like...
It looks dirty.
Yeah, it looks like...
There we go.
I don't know.
Cleanest shirt.
Torsten, it's good to see you. Torsten Slok of Apollo. Thank you, sir. Equity futures right now in the S&P, negative by only a few tenths of 1%. Let's give you an update on news elsewhere with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. The stablecoin bill advanced in the Senate, overcoming a procedural blockade. Democrats had initially opposed the bill due to concerns over President Trump's crypto dealings, but some dropped their opposition after negotiations. The regulatory bill is now set for debate on the Senate floor, with the bipartisan group hoping to pass it as soon as this week. Meanwhile, Honda is scaling back investment plans for electric vehicles as consumer demand remains weak. The Japanese automaker will now only invest $48.3 billion in EVs and is raising its expectations for hybrid vehicle demand. Last week, Honda said it's expecting a $3 billion hit to its annual profits due to President Trump's tariffs. And as you were just discussing earlier, 2 Federal Reserve officials, including New York Fed Chief John Williams, suggested policymakers may not be ready to lower interest rates before September. Investors see less than a 10% chance of a rate cut when policymakers meet in mid-June and expect 2 quarter-point reductions by year's end. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Up next on the program, the best buy in the world.
American bonds are the best buy in the world. They're going to be even better buy once all of our policies are in place. We support what it takes to get the bill through.
Going to take a lot. Daleep Singh of PGIM Fixed Income joins us next, live from New York. You're watching Bloomberg TV. Pleased to say our next guest is not wearing a grey shirt. Kevin Gordon of Charles Schwab is very offended, though. Apparently he owns grey shirts.
From Bottega Veneta, they're beautiful.
OK, Bottega shirts.
He can pull anything off.
OK, all right. I can't pull that off. Equity futures on the S&P, slightly negative. We're down by 0.2% on the S&P. Under surveillance this morning, the best buy in the world.
I think that American bonds are the best buy in the world. They're going to be even better buy once all of our policies are in place. And this downgrade is something that happened because of the runaway spending of the previous administration. They were the last agency to move, and I don't think it should be a surprise to markets. We support what it takes to get the bill through.
Here's the latest this morning. US Treasuries whipsawing after Moody's downgrade of US credit. Investors now looking ahead to President Trump's tax bill and the outlook for the nation's debt. Joining us now to discuss, the former White House Deputy National Security Advisor, now Vice Chair at PGIM Fixed Income, Daleep Singh. Daleep, good morning, sir. It's good to see you.
Good morning. Just for the record, this has a hint of purple.
You make that work. Yeah, it matches with the tie.
By the standards of New York or Washington, this is rebellion.
It sings. It's nice. It works. This bond market, let's talk about that.
Sure.
Does 550 fix it? Does 6% fix it? What wakes people up in Washington to finally do something about spending?
I think we're going to need a big, abrupt move in the back end of the bond curve to bring fiscal discipline to Washington. It's the last fiscal guardrail available. Right now, the fiscal plan that's making its way through the House does not meet my definition of credibility. $5 trillion debt increased, 6 to 7% deficits, and an interest expense category that's growing faster than any other in the U.S. budget. That's going to put the bond market to the test.
Which is a reason why a lot of people are wondering if structurally bonds have a different role than they have traditionally. Henry McVeigh of KKR put out a report this morning where he said, during risk-off days, government bonds are no longer fulfilling their role as the shock absorbers in a traditional portfolio. Given your experience in Washington, seeing how the sausage is made from the inside, do you agree with that? Do you think that ultimately there is not going to be that check and that ultimately there is a structural, fundamental change in the role for bonds?
Yes, and it's global. You look at the economic backdrop, we're talking about slowing growth coupled with sticky high inflation and interest rates. Then there's the national security overlay, a very strong flashing red demand signal for more defense spending, more fiscal spending everywhere. You see that in Japan overnight. And then you overlay that with politics. We don't have political centrism that's anchoring fiscal credibility in most Western democracies. You put all that together, and you have a structurally higher term premium in the back end that's going to take place, that's going to be injected in bond markets from Japan to the U.S. to Europe and everywhere else.
Well, if bonds are not a haven and they don't have a haven status, and you have central banks pulling back from bond purchases, and you have potentially higher inflation, what does that mean in terms of bond losses, in terms of a lost decade, in terms of just totally rearranging some sort of concept of returns that we've gotten used to?
I think you have to be cautious across the board in asset markets right now. You were talking earlier this morning about the possibility of a stock market melt-up. I don't know how you have a stock market melt-up under the dangling sword of a bond market meltdown. I think if you're discounting cash flows from any tech company 30 years forward, you have to take into consideration the possibility the next 25 or 50 basis points may be higher, not lower, and that changes your present value of cash flows and that changes equity valuations. I think it argues for caution.
What corrective measures are available, both of the central bank and across the administration? What's available when these kind of things happen? We saw back in November 23 that you can adjust the profile of the debt that you issue. Maybe you shorten duration, issue more T-bills. What's available to them?
Well, the central bank is not going to be the first mover. It's really up to the fiscal authorities to go back to the drawing board. And there are options available. We've known the answer for years, Jonathan. We have to concentrate spending where the growth multipliers are high, R&D, infrastructure investment, and we have to raise revenues where the growth drag is low. So think about corporate profits stashed overseas. And then we have to touch the third rail, which is entitlement spending. That would involve means testing of benefits, using chain CPI for payouts, expanding drug price reform. The sad reality is that's nowhere in the conversation, and that's what I think the bond market will eventually have to force.
Daleep, was that ever in the conversation, though, when you worked in the White House?
In the conversation, yes, but I was in the White House mostly during the post-pandemic period, and so we were trying to preserve the long-term productive capacity of the economy, prevent needless bankruptcies, prevent long-term unemployed, prevent another lost decade like we saw after the GFC. And so once we got out of that pandemic, the idea was to put the fiscal deficit trajectory on a path, 5 or 6%, declining to 3%, that the bond markets could find credible. And under current law, that's where we'd go.
If you look back in hindsight, do you think the American Rescue Plan went too much, especially in the wake of the Moody's downgrade?
Maybe 1 to 2 percentage points too much. But look, I think if you're thinking about this from a risk management standpoint, the risk of going too small was much greater than the risk of going too big. Again, if you lose the productive capacity of the economy, if you lose the ability to grow faster than your cost of capital, that's when your debt stock goes parabolic. We didn't want to repeat the mistakes of the post-GFC period.
This isn't, though, just a sell America trade. And this is important, and you referenced this when you talked about Japan. This isn't just a U.S. problem. This is a global problem. So where else are people going to go for that stability, given the fact that this isn't unique to the United States right now?
There's not an obvious answer. I think there are structural drivers that are causing bond markets to disanchor. And it's a world of intensified geopolitical competition. That's going to argue for more fiscal spending. It's a world in which, although we're competing more intensely across countries as we have in many decades, we're also coming apart from within. So political polarization means less political centrism and less regard for deficits. Those two forces combined, I think, give us a very difficult circumstance in terms of where do you put your money.
It raises huge questions about where to put your money and what the purpose of the bond market actually is. I think we understood the role that bonds played in a broader portfolio. There was that ballast in a portfolio. Bad things happened. That part of the portfolio performed well. How have the conversations changed with clients at PGIM? What are you telling them now?
Well, I think clients are focusing on where they can still earn carry, and that's on the front end of the curve. And so I think if you're putting your money in bond markets, short duration, high carry, high quality structured products, that's a place to wait out this turbulence. And the turbulence may go on for years and years, by the way. But we first have to see how the fiscal drama plays out in Washington before resetting strategy.
Can I ask you what you think does happen if we go into an economic downturn? Do bonds rally? Does the 10-year yield drop?
Yes. I mean, so if we get into a circumstance in which we have recession or a financial meltdown, then the Fed is clearly going to be put into action. It will cut rates aggressively towards accommodative territory. That will pull down yields in the back end. And we will see a much easier environment in terms of where to put your money in the bond market. But until we get to that point, there's going to be a lot of uncertainty in terms of how do you hedge.
The fact we've even got to ask that question speaks to the moment we're in. But I think it's an important question. What do bonds do in the next economic downturn? If you're worried about 6% deficits, welcome to 8. Welcome to 9, maybe more.
Where is the counter-cyclical fiscal response when you have a constraint about a debt market that really has yields that are much higher than they have been traditionally?
Daleep, this was awesome. It's always good to see you. Thank you, sir.
Pleasure.
Daleep Singh, the former Deputy National Security Advisor, now the Vice Chair of PGIM. Up next, we'll catch up with Jim Caron of Morgan Stanley, the White House Council of Economic Advisors Chair Stephen Miran, Alejandra Grindal of Ned Davis Research, and Amanda Lynam of Blackrock.
We are going to go through probably many trust moments. This is probably another mini earthquake version of this with the downgrade.
You don't have to be bearish, but boy, it's hard to be bullish.
I don't think that we're looking at a stampede out of treasuries.
We are taking profits rather than rethinking the basic strategy here.
I think the worst is behind us, but I don't think the coast is clear just yet.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts now on a 6-day winning streak on the S&P 500 and pulling back this much. We're down by 0.2% on the S&P, down by a third on the Nasdaq. Later on this morning, your main event, the President of the United States on Capitol Hill pushing his one big beautiful bill and trying to rally the troops, herd the cats, getting them behind this bill at a time where I have to say almost every single bond market guest on this program is nervous about extending duration for a whole host of reasons, including this one.
Yeah, not least of which is this idea that this big, beautiful bill is going to extend some of the increases in deficits that have happened over many years. This is a longstanding problem. This is not just this administration. But that said, the fact that it just increases the deficit by an estimated $3 trillion is giving a lot of people pause, given the fact that ultimately it's hard to see where the growth is going to come from. It's hard to see where the offsets are going to come from. And already we're looking at a 6% deficit.
This morning alone, PGIM, JPMorgan Asset Management, worried about the fiscal position not just of the United States, but also of the Japanese, not just a domestic issue, but a worldwide one.
It's a worldwide issue, but right now, looking domestically, everyone's going to be focused on, can the president close this deal? He's going to the House of Representatives today. I just have a question of, this is the first of how many trips he's going to need to make to the Capitol to try to close the deal, herd the cats for his 13B bill.
Well, this is just the House. Then you've got to get to the Senate. And in the meantime, yields are back up this morning by, let's say, 2 or 3 basis points to 492.
I'm struck by the fact that in 2014, 2015, people were likening to some of the low rate, zero rate policies, the quantitative easing, to heroin, to beer goggles, to whatever else you want to say. And they were saying it's going to be really painful when you try to wean yourself of these drugs. Well, guess what? It is painful. And that is what we're experiencing as people try to rectify a situation amid inflation that is not zero anymore, among rates that are not zero anymore. And suddenly the beer goggles come off, and that's where we're all at.
One piece of leverage this administration has, or the president has, to the entire group that are all trying to angle for what they want, is that if they do not pass this, we will have tax hikes. And that is something no Republican wants to go into the midterm elections with.
That was the Richard Fisher speech, wasn't it?
I read it last night.
Did you go back over it?
2014.
Very cool. Dallas Fed president, former Dallas Fed president.
Yeah, like a needle through the camel's eye and beer goggles and all that.
Whoever wrote speeches for him, I don't know if it was him or someone else, but fantastic speeches back in the day.
I actually heard it was very him, and that this was a very him speech, but it was fantastic because he was talking about how it makes every bond out there look good, and now suddenly they're coming off and people are saying, how can anything look good? We're all sort of in the hangover period.
I don't know about that 10-year or that 30-year. Yields are higher by 2 basis points this morning, 492 on a 10-year, 445. Big round trip yesterday, both in equities and in bonds. Coming up this hour, we'll catch up with Jim Caron of Morgan Stanley on a positive impulse for equities. The chair of the White House Council of Economic Advisors, Stephen Miran, on Trump's big, beautiful tax bill. And Amanda Lynam of Blackrock on expectations for steeper yield curves. We begin this hour with stocks struggling to extend a 6-day winning streak. Jim Caron of Morgan Stanley expecting more gains to come, writing the following. The Fed is more apt to lower policy rates to create stimulus despite risking higher inflation. This should support earnings and multiples. Jim joins us now for more. Jim, the question we've been asking all morning, do you think there's a bigger risk of a bond market meltdown or a stock market melt up?
Good morning. It's a great question, right? And as we've always talked about, that there are two sides to risk to the downside and risk to the upside. So look, I mean, the way that we're thinking about this right now, and let's start with the bond market. The bond market is in a position where people are a bit worried. They're nervous about the fiscal condition. These aren't necessarily new things. We recognize that the deficit is too high and it needs to be addressed. But I think on the other side of this, what we have to recognize is that, as you were saying earlier, President Trump is talking about tax policy right now. Now, remember, there's a process that we're going through. Number 1 is deregulation. Number 2 is tariffs. And number 3 is taxes, right? So this is a process. It's not total chaos, as sometimes the market likes to think that it is. Tariffs are definitely the negative, but deregulation and taxes are the positive. So right now, where we're going to start to focus on is what type of tax programs or stimulus, for example, like accelerated depreciation, corporate tax cuts for things made in America, a rebirth of manufacturing in the U.S. These are positives, but they're positives in different segments of the equity market. It's probably more about the broader mid-cap sectors, industrial sectors. It's not necessarily just about large cap tech and growth sectors. It's more about large cap value and like I said, the mid caps. So I do think that this is a positive, but we have to see this as a rebalancing. It's a rebalancing towards other segments of the markets that have really been left behind, and for all intents and purposes had almost zero growth over the past few years, several years, that may now start to resurge. So that's going to have different impacts on the overall index performance, but the constituencies of the index can actually do pretty well.
Well, that's the question, Jim. If I'm watching this morning, and hello to you at home, maybe on the trading floor, and you're parked in the index, market cap weight, what's your advice to them?
I'd say go to, I would not be market cap weight. I'd go more equal weighted. It's a very, very simple fix, because I think the market cap weighted index right now has become extraordinarily concentrated into large cap tech, right? So if you even just go back to 2010 to 2024, there's been an extraordinary growth in the large cap growth in tech sector. If you look at your portfolio in that context, you're overweight that sector. You need to rebalance that and get into other segments of the markets. So this is the challenge that we have right now. And there's one more element to this. You probably also have really high tax gains in that large cap tech segment of the market at this point. So therefore, it's hard for you to sell that and rebalance immediately. So it's a slow rebalancing. As new monies come in, you start to buy other segments outside of large cap tech in order to rebalance your portfolio, because if you sold large cap tech today, you'd probably get hit with a pretty high tax burden. So this is going to be a long, drawn out, idiosyncratic process that I think is going to be really good for active management, stock pickers, market times. All of the traditional portfolio management elements, I think, are going to be at work here. And that's the environment that we're in. It's a lot more tactical these days than what it was before.
Based on some of the conversations that we've been having, you could argue it's a bit like rearranging deck chairs on the Titanic if you have the overall market that's really constrained by a bond market. I mean, how much is this ultimately trying to make the best of a pretty challenging backdrop when it comes to both deficit concerns, inflation concerns, and growth concerns?
Yeah, it's a great question, Lisa. And this is something that, we've talked about on your show many times, is that the bond market today, it's changing its place in an asset allocation strategy. It used to be a very easy place to de-risk your portfolio, park your money in bonds, be passive in fixed income, and it did the trick for you. Today, what we're realizing is that there's more of a risk element to owning bonds. And this is why many people, including myself, were underweight duration, because it's not like more duration reduces risk. In fact, more duration might actually increase risk in a portfolio to some degree, unless we have a really big tail event where we move into a sharp recession or something like that, in which case long duration will work. But outside of that, what we recognize is that the interest rate cycle now may be moving sideways as opposed to just trending lower. This means that when you put together a balanced portfolio, you've got to be very active in terms of how you think about your fixed income, meaning you just can't sit passively at the index, at an index duration, and just hope for the best. You've got to think about segments of the market. For example, we like asset-backed securities, non-agency mortgages. We like, we're even starting to gravitate towards some components of the high yield market, which I think today with less recession risks actually looks very attractive. I would rather own those products with less rate sensitivity and more yield potential, as opposed to just holding longer duration, high quality bonds, because it's really about duration management in portfolios today. And that's something that we haven't had to think about for 40 years, because the bond market's been in a bull market from 1981 to 2021. It's only been really in the last few years that this has become an issue.
What's the risk of a real accident? And I say that because in the past, typically crises always occurred in assets that were perceived as safe, right? The home prices in the United States, when it comes to bank debt back in the 1980s. Right now we're looking at, as you defined it, the classic risk-free asset suddenly has risk. At what point do you worry about a pretty big hiccup, whether it's the 20-year auction tomorrow or whether it's something else that causes a real reckoning moment?
Yeah, I'm constantly worried about this, Lisa. I mean, this is the issue, right? So if I look at corporate balance sheets and if I look at personal balance sheets, corporate and personal balance sheets are in really good shape. It's the government balance sheets that are not in very good shape. So this readjustment that we're going through, and you're seeing this in the currency, which is one of the reasons why we're negative on the dollar. We think the dollar is going to depreciate. but from very, very strong levels, it's going to come back down. There needs to be a yield adjustment higher. It's a question of how fast that actually happens. So I'm not counting on 10-year Treasury yields moving materially lower this year unless we have a significant economic meltdown. I would argue that they stay around these levels or slightly higher. So we could be in a range, let's say in the 10-year Treasury, somewhere between 425 and 475. Let's call that the range. But for there to be if there were a real hiccup in the auctions, that would have shockwaves sent around financial markets, and that would be a pretty strong negative. And it would be addressed very quickly by the Fed, by the way. I think this would be contained. I don't think we would have a Liz Truss moment where things just spin out of control for days on end. That's just not the way the U.S. markets are set up.
Isn't it unfair that Liz Truss always gets the stick with regards to this? No one mentions Kwasi Kwarteng. Jim Caron, he was the Chancellor.
Yeah, well, I mean, I guess Liz Truss is in more recent memory because she was the leader. So sometimes you have to blame the leader.
Jim Caron and Morgan Stanley. I'm not sure Liz Truss is a fan of this so-called Liz Truss moment stuff in the bond market.
I have actually heard from a source that she is deeply angry by being penalized with this. And suddenly, the bond market gets yippy and people put pictures of iceberg lettuce up, and everyone knows what that is, and I'm sure she's not very happy about that either.
There's literally a Wikipedia page dedicated to Liz Truss lettuce, so.
It was a unique moment in the UK, let's put it that way. I'm not going to get into the details. All right, in the bond market and treasuries at the moment, yields are higher by 2 basis points, 4.46 on a 30-year. No drama here this morning at the moment after yesterday's round trip. Yields are higher by 3 or 4 basis points, 4.94. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. Home Depot shares are rising 2.2% in the pre-market. Sales for the home improvement retailer came in slightly weaker than expected, but it did reaffirm its full-year guidance. The company's CFO noted bad weather hurt sales in the winter months, but demand then improved in March and April. He also said positive sales have continued through the first weeks of the current quarter. Meanwhile, President Trump held a 2-hour phone call with Russian President Vladimir Putin yesterday. Following the call, he said on social media that Ukraine and Russia would, quote, immediately start negotiations toward a ceasefire. Trump said the U.S. would not participate in the talks, but didn't rule out further sanctions on Russia. And President Trump is heading to Capitol Hill later this morning to try and seal a deal on his big, beautiful bill. Trump has told GOP holdouts to, quote, stop talking and get it done. But there is still disagreement over the bill's tax breaks, cuts to Medicaid, and green energy programs. Even if the bill passes the House, it will face an uphill battle in the Senate. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next, the morning calls, plus the chair of the White House Council of Economic Advisers, Stephen Miran, on President Trump's big, beautiful tax bill as the president heads down to Capitol Hill. Live from New York City, this is Bloomberg. The opening bell a little more than 1 hour around the corner. Equity futures into that negative by 0.2% on the Nasdaq. We're lower by just about 0.3. That's the price action. Your morning calls look like this. First up, Truist, reiterating its buy rating on Home Depot, expecting more sales and earnings gains this year. That stock is higher in the pre-market by 2.3%. Your second call from Citi, raising its price target on Trip.com to 78, saying the company's results show resilient leisure travel demand. That stock is still negative by 4.8% in the pre-market. And your third and final call from Morgan Stanley, the team over there raising their price target on JPMorgan to 236, seeing runway for growth across divisions and products. That stock just about unchanged in early trading. We're down by not even 0.1%. Let's turn back to the tax bill. President Trump heading to Capitol Hill shortly, hoping to unite House Republicans on his agenda. Stephen Miran, the chair of the White House Council of Economic Advisers, joins us now for more. Stephen, welcome back to the programme, my friend. Let's talk about the president's message for House Republicans a little bit later this morning. What's top of mind?
Good morning. Thanks for having us. Well, what's top of mind is the Council of Economic Advisors just published a paper. It's available on our website talking about all the good stuff this tax bill is going to do. It's going to boost GDP relative to not passing the bill by about 4.2 to 5.2%. It's going to create 7 million jobs, and it's going to boost take-home pay for a typical family of four by $8,000 to $13,000. So these are really big effects relative to not passing the bill. It's imperative that we get this bill over the line.
Steve, though, when I'm talking to individuals in Congress and then reading your white paper, you have a 15% corporate tax rate in your white paper. Right now, that's not being discussed in Congress. Do you think the president is going to bring that issue forward today?
You know, I can't prejudge the outcome of exactly what these talks will do, but that 15% corporate rate on domestic manufacturing will help at the margin, but it's not the core of the proposal. Those numbers that I gave you will be pretty similar if that doesn't make it into the final version. Maybe it'll be a hair lower, but you have to keep in mind there's a lot of stuff going into this bill, and any single one of these measures isn't enough to sort of change those numbers a lot, because all these measures combine together to improve the investment opportunities in America, to encourage firms to invest, to encourage firms to invest in new equipment, new factories, all this stuff.
There's a ton that's going into this bill, and that is why it's even so challenging for Speaker Johnson to get all these different factions on board. Something else you don't have in your paper, though, is what's going on in SALT. Do you expect the SALT cap to raise, say, 30K, 40K?
Yeah, so I do expect there to be SALT relief. The president has expressed support for this, and I think the president will deliver SALT relief to American households. I don't know exactly what the number will shake out in, and as you know, this is how negotiations happen. One side says what it wants, the other side says what it wants, and the president is one of the best negotiators in history, and he's shown over a career spanning decades that he can forge hundreds of deals, and I think he'll forge another one right in front of us now.
There is a good element in this, that you're focusing on growth, and I do think that that is important. You can't cut too much. You have to offer some sweeteners to keep growth going, to keep the revenue side of things going. I do wonder, though, how much of a constraint the debt side really is, given the fact that looks like things are getting a little yippy again in the bond market.
Thanks. So I'm so glad you mentioned that, because the truth is that we do have a plan for deficit reduction, and we will deliver lower deficits. It just happens that some of those things fall outside of the scoring process, how CBO scores the bill, because of the rules that Congress gave it. And so, for example, we're going to get better growth as a result of this bill, as a result of deregulation, as a result of the trade deals we're negotiating. We get growth to 3%. That generates $4 trillion additional revenues over the 10-year budget window above the CBO baseline. That doesn't go into the scoring process because CBO doesn't account for improvements in economic growth. We're going to bring in hundreds of billions of dollars of revenue through tariffs, right? That's another point off the deficit. We're going to bring interest rates down through expanding the supply side of the economy, through more effective tax rates, through deregulation, through pushing the supply side out to meet the demand side. We get interest rates back to where they were pre-COVID. That's another point off the deficit. And then there's cuts to waste, fraud, and abuse, some of which are in the bill, some of which are being accomplished by DOGE. That's another 50 to 100 basis points off the deficit worth of GDP. So I just gave you 3 to 4% of GDP off the deficit. None of it falls into the scoring system that the CBO is doing. And yet the conversation is, for some reason, dominated by CBO.
Well, part of the reason why it's not being scored is because there are a lot of contingencies before you get to all of these realities. And I'll just pick out one, since we were talking about the bond market, the idea that yields go down as you increase the supply side of the economy. There's a pretty bumpy path to get there. Do you have enough faith in that you ignore USGG 30-year index GP, that you ignore the 30-year yield, you ignore the 10-year yield in the near term, and just have faith that longer term it'll work out?
Yeah, so look, we're still dealing with the lingering inflation pressures due to President Biden's reckless fiscal policies, but we are bringing those inflation pressures down through pushing out the supply side of the economy. We've had now 3 inflation reports in a row below expectations. Core inflation on an annual basis is running the lowest level since March of 2021. And as we continue to control inflation, it will provide scope for interest rates to come down. I have no doubt about that.
Well, Steve, the American people are concerned about prices going up. The latest being Subaru. They're going to be increasing their vehicle prices, citing, quote, market conditions, a.k.a. concerns about what's going on with trade and tariffs. How can you say you're delivering on inflation when actually companies are warning that prices are going higher?
Yeah, so look, imports are only 14% of the economy. The ability of those types of things to really move the needle on inflation are limited. And what we saw in the tariffs in 2018, 2019 was zero macroeconomic evidence of inflation. What we've seen so far since the tariffs have been, and don't forget, we've been introducing tariffs since day one of this administration. And what we've seen as tariffs have started to come up has been no real meaningful macroeconomic effect on inflation. And so while there can be volatility in the short run, I do believe that U.S. importers have flexibility about where they get stuff from. They can make stuff at home. They can import from other countries that treat us better, that write trade deals with us, as opposed to countries that treat us worse. And that flexibility gives them leverage. That leverage allows them to force the burden of the tariffs on the other party, on other countries. Now, in the fullness of time, that'll happen. But in the short run, can there be volatility in prices and economic activity, just as there were in financial markets? Yeah, it can happen. But over time, we have the leverage, and that'll allow us to force the burden of the tariffs onto other countries.
When you think about tariffs, do you think they're going to be revenue raising, or do you think that we're going to get deals so the revenue raising won't be as high? And do you have a number within the White House that you're discussing, which how much you want to get in terms of revenue raises to offset this tax bill?
Sure. So first of all, what we've seen with some of the deals we've made so far is that there's still a 10% tariff in place. And in the case of China, there's other tariffs too, the fentanyl tariffs, the tariffs from the first term as well. And so even if we strike deals, odds are we'll still be collecting some tariff revenue. But even if we end up bringing those tariff rates below or down to zero, that means more economic activity. If we're writing deals because we're succeeding in opening foreign markets to our exports, allowing American firms to sell into foreign markets the way we allow foreign firms to sell into our market, that means more economic activity here because of more exports. And if there's more economic activity, more exports coming out of America going to foreign markets, that's more income that gets taxed at the personal level, at the corporate level, and that's lots more revenue too. So either way you slice it, we get revenue from tariffs or we get revenue from higher GDP because we're selling more to other countries.
Sounds like win-win, Stephen. Let's hope it ends up that way. Stephen Miran there, the White House Council of Economic Advisors chair. A busy morning for him. Catching up with the president a little bit later this morning. The president on Capitol Hill trying to herd the cats. The House Republicans trying to get them to unite later this morning.
Yeah, they're betting on this growth that's going to come from all of these factors, as well as potentially opening up trade globally, but with tariffs that also provide revenues. It's difficult to get your arms around all of this, which is why I think there is so much disagreement among a lot of Republicans about how exactly to accomplish it.
On the tariffs, he said in the fullness of time, ultimately it'll be the exporter that has to absorb the cost. The president basically acknowledged over the weekend that it would be both China and Walmart that will have to, quote, eat the tariffs and don't pass it on to the consumer. So which one is it? That's going to be the debate over the coming years.
It's going to be the debate, but then when the Treasury Secretary spoke about it, it did sound like it was going to be Walmart that was going to have to eat a lot of this. Because remember, Walmart also went to China and was trying to have these discussions with factories, and they were saying, we don't want to touch this. This is on you. So Walmart's going to be the one to eat it, and whether or not how much they pass along to the consumer, we're going to be witnesses of in the next few weeks.
How the cost is shared was always the debate. By definition, the importer pays the tariff. We've said that repeatedly. That's just how this thing works, technically speaking. How the cost is absolutely distributed, how it's shared, is where you're going to see a lot of debate. And the president clearly thinks he's got a role to play in bullying corporate America into not passing it on.
And he has. They have changed their language from due to tariffs to due to economic conditions, and that seems to be the remedy. I do wonder how much Trump 1.0 can be an example for the economic ramifications and inflationary or non-inflationary impacts of tariffs, because it was a much smaller pool that was susceptible to them.
The tariff levels are very different, and it's way broader as well. Not just China this time around. Equity futures on the S&P negative here by 0.2%. Up next, Alejandra Grindal of Ned Davis Research and Lynam of Blackrock. From New York City, this is Bloomberg. The president heading down to Capitol Hill to put some pressure on his Republican colleagues in the House to unite behind his big, beautiful bill down in Washington, D.C. That's the main event, really, for markets, how that one comes out and what it means for this bond market and whether those yields constrain this equity market. Equity futures this morning look like this. We're down by 0.2%. On the Nasdaq 100, we're negative by 0.4%. With 60 minutes until that cash open with your morning movers. Here's Yahara. Hey, Yahara.
Hi, John. We start with UBS. Those shares continue to fall, down nearly 3.5% now. The bank had been lobbying the Swiss government to water down a law that would require it to maintain up to $25 billion in extra capital, but to no avail. We're reporting here at Bloomberg that it is likely not to win that effort, though I will note the text of the law is still being finalized, so its prospects may still change. Next up, we have Amer Sports. This is the company behind Wilson tennis rackets and, as our avid skier Lisa knows, Salomon ski boots. Well, it's being rewarded handsomely here in the pre-market, up more than 10%, because not only did it top first quarter results, it also boosted its adjusted full year profit outlook. Oh, and it said this: it expects the impact from higher tariffs to be negligible. So, music to investors' ears. And last up, we have Home Depot. We were all waiting for these earnings. Shares are higher by 2%, even though sales did come in light. But it's the confidence that it projected that helped the stock rise here, because the CFO says they've done the work to diversify sourcing, and because of that, they won't need to hike prices in the face of tariffs, and they plan to diversify even more. He said that no country outside the U.S. will represent more than 10% of purchases. John?
Stock is up in the pre-market by 2%. Yohara, thank you. The opening bell is just around the corner. Fed speak in focus. Fed Presidents John Williams, Raphael Bostic warning interest rates could be on hold until September. Another busy day of Fed speak on tap. Bloomberg's Mike McKee joins us now from the Atlanta Fed conference. Mike, welcome back. We've got meetings on June 18th, July 30th. Are they telling us to book a round of golf and give those a miss?
Absolutely. Fed officials don't think they're going to have the data. They don't think at this point they're even going to have the information about what the president is planning. Certainly not by June, maybe not by the end of July. We're in the middle of a 90-day pause on reciprocal tariffs that doesn't end until the first week of July, and then that puts the Chinese pause into late August or early September. And so there's still a lot of uncertainty. I hate to use that word, but it gets overused. Uncertainty about what's going to happen. So they're going to sit back for a while, and I think that, and this is kind of the feeling you get in private when you talk to Fed officials, is they're thinking, don't watch them right now, because they're not going to give you anything. They're going to be watching like the rest of us as the data come in.
And Mike, that begs the question whether September 17th is too soon. Maybe you know the policy, but you might not know the outcome of that policy and what it means for the economy.
That's exactly right, John. They don't know they don't know anything about how to model this because of all the various possibilities. So even if they get some hard data that comes out in July that we get in August, you won't have much August data by the time of the September 18th meeting. So it's very possible we don't see anything until October or after. It's going to be a slow build for whatever this is. And then you've got to throw in whatever shorter term impacts the budget bill has. They're looking at a stimulus for 2026 because of things like no tax on tips and the benefits for Social Security recipients, et cetera. So if people have a little more money, they'll be spending that. And then you got to figure that into what is going to happen, because, of course, policy works with a lag. The Fed has to think, what's it going to be like a year from now? And now they're looking at what's it going to be like 18 months from now before they can think about what has to happen.
Whipsawed. Mike McKee, appreciate the update. Looking forward to your reporting throughout the day down in Florida at the Atlanta Fed conference. Lisa, this is the issue they've got. The policy volatility of the last month arguably slams the brakes on the economy through the summer, potentially. And then maybe things speed up again with the stimulus that could come from the tax bill that's coming together down in Washington this morning.
They have no incentive to do anything other than, if I dare say, wait and see, because that essentially is the only thing they can do at a time where it is not blaringly obvious. Neil Dutta, I'm sorry, you can write to me and tell me that, yes, it is blaringly obvious, but it isn't blaringly obvious that they should move one way or another. You are seeing activity continue. You are seeing inflation continue to come down, but still from an elevated place. There's no real incentive for them right now to take a stand.
Is that what Neil does?
What?
Like a live blog of everything you say and then pushes back?
Yes, sometimes. Hi, Neil.
Give it a few seconds. Annmarie just getting an understanding that the president is on his way to Capitol Hill, and that's the man to watch right now. It's not Chairman Powell.
That's right. Speaker Johnson said he had a phone call with the president. He's going to be making his way over, going to talk to these House Republicans. We're excited to have him, that's the speaker saying. And he says he's going to encourage everyone this morning to get in line and get the votes done. Again, this is a negotiation, and right before you get to yes, there's going to be a lot of maximalist demands from every single faction in this room, and that's why it makes this job for Speaker Johnson so challenging.
Joining us now to build on some of this, Alejandra Grindal of the Ned Davis Research. Alejandra, welcome to the programme. Let's just talk about this Federal Reserve and get that out of the way, and then we can talk about the president and his policies. Is September, even September, too soon to really know what these policies mean for this economy?
Thanks so much for having me. I do think September is still on the table. We'll have a few more months of data by then. We'll perhaps see some impact on the job market. We have seen some policies since the beginning of the year associated with the tariff uncertainty, as well as the DOGE cuts, as well as some immigration policies. But I agree with what Michael McKee was saying earlier. I don't think the Fed fully knows what it's going to do. Like the rest of us, everything is extremely data dependent. And again, using a term we don't like to use all the time, but there's just so much heightened uncertainty, which makes this environment so difficult.
What model do you use, let alone inputs, to even begin to start to game out some of the economic ramifications of policies, let alone from the Fed, but really fiscally?
Yeah, I mean, this is, again, a very tough environment because things are moving quite quickly. So obviously, a lot of the biggest changes we'll see initially will be in the financial data, what the markets are telling us. Also, a lot of the soft data, it comes in with a little bit of a lead, so we can at least directionally gauge where the economy is going to go. I also like the PMI data. We'll get a flash estimate for the month of May, I believe at the end of this week. And to me, that has some indications of hard data because you are asking businesses, what are you doing with orders? What are you doing with output? In terms of the fiscal situation going forward, previous guests have talked about the impact of the higher yields and the rising debt. Going into, say, the second half of this year, we could potentially get a tax cut package that could be expansionary for U.S. growth and provide at least some sort of upside, risk to maybe some of these downsides we've seen at the beginning of the year. But it could also be inflationary, which could have an impact on long-term yields and make the debt less sustainable.
Is there a sense right now, Alejandra, from your point of view, that the downside risks to growth are greater than any upside risks to inflation, even with some of what's on the table in Washington, D.C.?
Well, you could get a little bit of both, right? So one of our views at NDR is, I hate to say this word, but we could be facing perhaps a stagflationary risk. And this isn't anything necessarily of 1970s proportions. I don't want to go out to that point, but we could see, because of these policies, again, because of the immigration policies, the DOGE policies, the tariff policies, which are creating uncertainty, we could see slower economic growth, below potential growth in the U.S., no recession, but still slower growth. And then the balance of risk to the upside of inflation, again, not going back to 1970s or inflation, or not even 2022 inflation, but we could see upside risk again because of the tariffs, because of the tax cuts potentially increasing inflation a little bit. And then a lot of the immigration policies impacting other services related sectors. And we could see a shortage of workers in that area. So you could see higher than normal inflation or this deviation to the upside, and then growth, below potential growth. And I think you could see the balance of that happening, which will make the Fed's job very, very difficult. And I think that's why they're standing on the sidelines and looking at the data.
Well, what if by September, October, that is the picture? What do they do?
Oh, it's a tough call. I mean, I still think rate cuts are the way to go, but the intensity of the rate cuts that happen may not be quite as much as we'd maybe want to anticipate if we do see that higher than normal inflation.
Alejandra, before you go, I've got to ask, because I'm getting grill envy. Is that real behind you?
It is absolutely real. I am also in Florida, so I get this beautiful sun all year round.
You can host us next time. We'll come to you, by all means. Alejandra, appreciate your time. Thank you. Alejandra Grindal.
Have a great day.
Of Ned Davis Research. We're doing it wrong, aren't we? What are we doing up here?
We have this discussion all the time. Why? I mean, honestly.
I love how, because it looked so good, we were all like, it's got to be a Zoom backdrop.
I feel sorry for the next guest. Amanda Lynam of Blackrock joins us now. Amanda, what have you got? What's the background? Playing this game again. Amanda, welcome to the programme. It's up there.
Thank you for having me.
It looks organised. The flowers are nice. I'm not going to get into this. This feels very pandemic, doesn't it? Let's talk about fixed income. The risk to the economy, upside risk to inflation, downside risk to growth. We've talked about this for months. Are you encouraged enough by the recent developments to go down in credit quality?
Good morning. Thank you for having me. I think absolutely the recent developments on the trade front have really trimmed some of that left tail, so to speak, that sharp downside risk to growth. And as you know, we've been comfortable moving, I would put the emphasis on selectively down in credit quality. And really the reason there is twofold. One, it's because fundamentals in a large part of the corporate market have really improved over the past few years. And then two, that extra spread premium that you can pick up by selectively moving down in credit quality buffers some of that volatility on the Treasury side, both in terms of duration exposure and in terms of just the really tight spread levels that are on offer in the highest parts of the IG spectrum. So we like that moving forward. I would say the one caveat to that is we're very conscious of I would say in the liquid and private credit markets, the pockets of the universe that have already been under fundamental pressure before the economic data deteriorated. So that would be companies with leverage over 6.5 times, triple C's and high yield already have interest coverage below 1 times, companies with stretched fixed charge coverage. I think we can feel pretty comfortable saying the growth backdrop is going to slow from here. The magnitude is yet to be determined. So those companies and sectors that were already under pressure, we would want to steer clear of those because we're not seeing anything on the horizon that makes us more confident about the growth backdrop.
Amanda, at what point do the credit fundamentals not matter? And I ask this at a time when typically all of these instruments, these credit instruments, are pegged to the supposed risk-free asset of U.S. Treasuries. When U.S. Treasuries are perceived as risky, particularly on the long end, how much does that upend traditional credit metrics for, say, high yield or investment grade credit?
It's a great point, Lisa. I think the credit fundamentals still matter very much. In fact, in our conversations with investors over the past 3 weeks, especially since these trade developments, what we're really sensing is this kind of back to basics focus on underwriting, structure, cash flow. I think maybe what's changed over time is that parts of the historically risky part of the credit market have converged up into their investment grade peers. So to give you an example, and you can see this data on the Bloomberg terminal, the trimmed mean leverage for the double B pocket of the market, so that high end of high yield, is actually exactly the same as the low end of investment grade. So there's been a convergence in credit quality across these pockets of the market such that the bright line of being IG or high yield probably doesn't matter as much anymore, but the structure certainly matters. And I think investors are highly attuned to what they can control in this environment, given the uncertainty, and that's, is a company well positioned? Does it have the pricing power? Does it have the ability to navigate through? Those things are reigning supreme. And I would say probably even more so than a few years ago when it was kind of a rising tide lifts all boats macro environment. We had above trend growth in the US. We don't have that anymore. So I would say fundamentals have featured more prominently in our conversations in recent weeks.
Amanda, let's say you get a call today from a client who saw Jamie Dimon yesterday talk about some of the risks in credit markets. John was mentioning this earlier. He said credit today is a bad risk. He talked about how people are overly complacent. The market came down 10%. It's back up 10%. He was talking about equities, but it also applies to riskier corporate credit. At what point are we underestimating the effect of tariffs that are still some 6 times where they were earlier this year?
Absolutely. I think one of the key, I would say, recognitions from investors, given the news flow over the past several weeks, is that a lot of these developments are very hard to time. And there, just as much as there is a focus on downside risk, there is also a focus on what could go right and being and avoiding a situation where investors are too defensive or under risked. That was the big takeaway from 2024. There was an opportunity cost to being too defensive. To your great point, Lisa, I absolutely think there is some room for spread widening from here. I think, however, there's just a recognition that investors can't time this. And so kind of legging in at this moment in time with all-in yields where they are, it at a minimum provides some buffer for volatility going forward when you can kind of just capture that yield and that carry. I've been surprised about how quickly credit spreads have retraced back. As you know, we were expecting widening. That was even shorter lived than I would have anticipated. You can see significant demand in inflows and primary oversubscription levels in the new issue market. So there's a lot of, I would say, competing forces at play. There's a delicate balance. And I do think investors are very focused on the risk, on the upside risks.
Well, when it comes to the upside risks, do you think that'll be in trade deals happening sooner, or potentially this tax bill getting through the House and the Senate and potentially the president's desk by midsummer?
I think it's a great question, Annmarie. I think really the trade has been the focus for investors, at least over the past several weeks. And as it relates to the tax developments, to us, that doesn't seem to be really an expectation of a large fiscal boost, rather just kind of extending the status quo, maybe some tweaks on the margin to provide some support for the economy. But really, I think what investors are most attuned to is kind of eliminating that really sharp risk of a downturn in growth because of a significant disruption in trade policy. As you know, we've been watching this feedback loop between corporate margins, the layoff rate, consumer spending, and overall economic activity. That's really key to, I think, risk appetite across the board, but especially in credit. I actually thought it was really notable that Atlanta Fed President Raphael Bostic said to Mike McKee yesterday that he was watching corporates signaling in his discussions around his district. And so that company level commentary in real time, I think, is going to be key. And I think it really does boil down to the forward path for trade policy and then some of these other incremental policies on the margin.
Amanda, I appreciate the update from you. As always, Amanda Lynam there of Blackrock. That interplay that Amanda keeps talking about, I think is so important. What happens with margins? Do you have to start reducing costs, lay off workers? That's going to be the thing that would spook a lot of people through the summer, and hopefully that's not what we see.
We are seeing the idea of margin compression. We haven't seen it really go to this question of layoffs, and people say that the scarring from the pandemic looms large in corporate executives' minds where they laid people off and then couldn't get them back quickly enough when the tides turned.
We've underestimated the strength of this economy repeatedly. Over and over again. You've got this massive spread between soft data and hard data. I get it. And a lot of people think the hard data is going to catch down to the soft data. But imagine a summer where the soft data catches up to the hard data and bounces again off the back of a tax bill, off the back of some trade deals.
I talked to someone in the corporate executive space yesterday, and they said there's a difference between a temporary tattoo and a permanent one. And if you thought that it was a permanent one, you might be making changes than if you thought that it was a temporary one, which seems to more be akin to the situation we're in.
Do you want to share who that person was?
No.
They're talking tattoos.
Well, there's this idea that...
Trying to guess who that would be.
Let's move on.
OK. Equity futures are down by about a third of 1%. We will move on. We'll get you an update on stories elsewhere. With your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. The Chinese government has accused the Trump administration of undermining recent trade talks in Geneva. This comes after the Commerce Department said it was issuing guidance to make clear the use of Huawei AI chips anywhere in the world is a breach of U.S. export controls. China said this is a discriminatory measure and demands correction. Meanwhile, Wynn Resorts is dropping its pursuit of a casino license in New York. The company said a rezoning process and local opposition made the opportunity to build a casino resort in New York's Hudson Yards less attractive. Wynn said it can make better use of its capital, including by share buybacks. And in a win for crypto, stablecoin legislation overcame a procedural blockade in the Senate. Democrats had initially opposed the bill due to concerns over President Trump's crypto dealings, but some dropped their opposition after modifications. The bill is now set for debate on the Senate floor, and a bipartisan group is hoping to pass it as soon as this week. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Thanks for this morning. Up next, we'll set you up for the day ahead as the president heads down to Capitol Hill to help negotiate a monster tax bill. The opening about 38 minutes away. Equity futures here, just a little softer. No real drama though. We're down about 0.25% on the S&P. Where there might be some drama, check out the bond market, long end of the curve. Just keep an eye on this. Yields starting to back up again. We're up by 5 basis points, approaching 5% again. 495 on 30s as the President of the United States heads down to Capitol Hill to negotiate the tax bill. Speaker Johnson saying the President will unify everyone. That's the one to watch through today. Happening right now. The President meeting with GOP lawmakers on Capitol Hill, plus a slew of Fed speak with the Atlanta Fed conference continuing. Tomorrow, we'll get you some earnings from Target. Thursday, PMI data, plus another round of jobless claims. Friday, final data point going into the weekend, new home sales. With us on Capitol Hill, let's cross over to Tyler Kendall. Tyler, Speaker Johnson saying the President will unify everyone. How difficult is that at the moment?
Yeah, hey, John, it's going to be a pretty big task because at the moment, we really haven't seen any indication from these lawmakers that they're going to abandon their respective policy decisions, with many of them telling us that this opportunity to make these changes when it comes to tax cuts and also the spending plans doesn't really come around all too often. Now, President Trump is going to arrive here to Capitol Hill with the message that they need to get the deal done because House Speaker Mike Johnson maintains they're going to pass this reconciliation package by Memorial Day. And why that timeline is important, it's because the broader White House wants to see this done by July 4th, and the legislation hasn't even moved to the Senate, where we know there's going to be a lot of big changes. We're going to have to see where those compromises come from. As you well know, there's really two big sticking points and factions at the moment. One is, of course, the SALT caucus, with Stephen Miran telling you earlier on the program that he does think there will be SALT relief. And then the other is the fiscal hawks and whether or not they can find the sort of aggressive revenue raisers and spending cuts in order to reach a deal.
It's Alejandra. Looking forward to your reporting throughout the day. Alejandra there on Capitol Hill as those talks get underway any moment from now. Speaker Johnson saying on SALT, we'll get the job done.
Well, they didn't last night. This is the problem. And they're going into a rule committee 1 a.m. on Wednesday that it has to pass the rule committee to go to the floor to meet his self-imposed Memorial Day deadline. They will get the job done, maybe, potentially. The problem is there's enough holdouts in each of these factions to tank the bill. So the second he starts going up higher on the SALT cap, what does that mean for the likes of Chip Roy and the fiscal deficit hawks? They're not going to sign up for that. This is why this is so challenging, and it's why they had to call in the big guns, as Politico called it, and the president to come try to herd some cats.
This bond market looms large. The good news is that we're not seeing a dislocation in fixed income. There was a worry about that last month. Yields are higher by 5 basis points this morning at 4.95. But this is one of the big reasons that we've had a whole host of guests on this programme this morning saying they don't want to touch that. They don't want to touch it because they don't know what policy is going to look like in Washington.
Which is the reason why I think the biggest risk event for this week could be tomorrow at 1 p.m. when there's $16 billion of 20-year notes being sold by the U.S. Treasury Department. If they have the big, beautiful bill come out with some $4 trillion, $3 trillion increase in the budget deficit over the next 10 years, and you have ongoing concern about exactly how many of the cuts are going to go through, how successful is this auction going to be at a time where 20-year debt tends to not do very well anyway because it's not that liquid? It is a big concern.
Looking ahead, though, all of this is happening in July. That first week of July is going to be so important. They want to get the tax bill, 13B, across the finish line, signed on the president's desk. That is also the end of the 90-day reprieve from quote-unquote Liberation Day. If they can get all of this done in July, that means businesses will be starting the fall, barring maybe China, with some clarity.
Just for the record, second time you've done it. Is that the new branding? 13B?
It's my new branding,
that's official.
13B.
13 big. One big, beautiful bill.
13B.
You running with that?
That
Do you
sounds
like
I guess it's 13Bs.
Okay.
All right. I think that could work. 1 BBB.
We'll see
I think
if we make that work.
It makes it look like it's kind of like a flow chart. Could be kind of bill sounding.
1 triple B.
All right. I've got to go. Okay. That was fun, though. Appreciate that. Yields up 5 basis points on 30s at the moment, 4.95 on 10s, 4.48. Just a programming note in the next hour. Don't miss this. The Tesla CEO, Elon Musk, joining Bloomberg's Misra Hossain for an interview at the Qatar Economic Forum in Doha. That's a must-watch a little bit later on this morning. And coming up tomorrow, a programming note from our side. Peter Chia of Academy Security, Stuart Kaiser of Citi, Sarah Malik of Nuveen, Lindsay Piazza of Stifel. From New York City, thank you for choosing Bloomberg TV. For our audience worldwide, this was Bloomberg Surveillance.